We are in Liberation Day 2.0.
Markets would have been relieved to get past the tariff issue, and it seems like it's going to be front and center again.
Right now, it's a bit of wait and watch.
A high tariff scenario is where we're going to be.
I don't think it changes the overall narrative for the marketplace.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, President Trump preparing to address the nation.
Supreme Court's ruling on tariffs is deeply disappointing. They also are a, frankly, disgrace to our nation, those justices. I can destroy the country. I can do anything I want, but I can't charge $1.
The Supreme Court justices who ruled against the policy, striking it down, are they still invited to your State of the Union?
Honestly, I couldn't care less if they come.
Getting set to face down Supreme Court justices following their headline ruling, leaving the White House, threatening trade partners with a fresh round of tariffs, is hitting a stock market already weighed down by another wave of AI anxiety. The hits keep on coming.
So trying to decipher what happened yesterday, good luck, right? How much is this concerns about any kind of uncertainty tied to a new tariff regime that maybe is 15%, but for now is just 10%? At the same time, there was a post by Citrini7, this research firm that everyone pinpointed as the reason why a lot of markets, in particular software stocks, were down even further. It was literal fiction talking about a 10% unemployment rate hypothetically in the next year or two, and yet it really ignited the fears of some sort of dystopian future on the heels of AI progress.
I enjoyed the mental exercise Sunday evening reading the note, didn't you?
I did too. I thought it was fantastic.
I thought it was fantastic. Didn't expect it to lead to the sector-level disruption that we saw play out in Monday's session, but here we are. At the index level, not spooked at all. Still 2% away from all-time highs on the S&P 500. Notable where the calm is. 10-year bond yields near the lows of the year and just kind of anchored, sticky around that level at the moment.
To me, that's important. Before the tariff ruling, we were saying that if those IEEPA justifications for tariffs were overturned, what you would get is a sell-off in bonds, because ultimately that was the revenues that was going into supporting a lot of the bull case for bonds. That wasn't the case. And actually, these came out as the haven. Why? Because in this dystopian future that Citrini7 laid out, unemployment's going to spike and the Fed's going to have to respond. So there is going to be some sort of policy response. In that dystopian fiction world, I would have to imagine NVIDIA would do very well, which they did okay yesterday, but so did Micron, AMD, and Broadcom. They all fell yesterday. So did Microsoft and Google and Amazon and Meta. So try to put this all together, I don't know. I'm having trouble.
Earnings from NVIDIA, of course, later on this week. The main event later on this evening, the President of the United States addressed the nation. Trade, very much the center of the focus, I think, for a lot of people in financial markets. Affordability as well. If there is a legitimate criticism of the Supreme Court, why did it take so long? And if there is a legitimate criticism of the White House, why did you do it this way?
That's the question I've been asking. If you knew that this was going to be potentially on dubious legal footing, why didn't you do the investigations for 232s and 301s, which you're going to end up with in the middle to the end of this year from the very beginning? I think you can see the president is incredibly frustrated, whether it's his Truth Social post or the Friday press conference he gave with the Supreme Court justices, which, by the way, are going to be sitting front row today when he gives the State of the Union address tonight. And I imagine this president, he calls it a weave, is going to go off script at some moments and maybe potentially call out individuals like he did Friday evening after they came out with that IEEPA ruling.
I think it's fair to say it's going to be box office a little bit later on this evening. Look out for that. Also tracking the financials this morning. On the S&P, just had their worst day since last April. JPMorgan this morning, firmer by 0.25%. Jamie Dimon of JPMorgan with this to say: I see a couple of people doing some dumb things. They're just doing dumb things to create net interest income.
So a couple of things here. First of all, Jamie Dimon is often chief risk officer and chief prognosticator about potential risks out there, and this sort of fits in line with that role. Second of all, the big banks have not been as involved in private credit, so it can be a more open ball field to really go after private credit, especially with some of the software concerns. And third, there are some dumb things, right? Let's be honest. The idea of chasing retail funds for long-term private illiquid loans has already been proven to have some potential pitfalls. Nonetheless, is it having the potential for 2008 types of consequences? Very few people seem to think that.
He also was talking about how there's always a surprise in the credit cycle, sort of what you're saying. There's someone always doing maybe something that could be viewed as dumb. He goes on to say it's really the surprise of what industry gets affected. Quote, this time around, it might be software because of AI. Well, obviously, we've been talking about that for weeks, so not exactly something that's breaking news or headline-worthy from Jamie Dimon.
Equity futures this morning doing better, up by 0.25% on the S&P 500. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth with markets seeking stabilization. Doreen Edelman of Lowenstein Sandler previewing President Trump's address tonight. And Jane Foloey of Rabobank saying an early Lagarde exit is the best case for the euro. We begin this hour with stocks edging higher following the latest AI-driven sell-off. Cameron Dawson of NewEdge Wealth writing the following. The more we see defensives rally and cyclicals stumble, the more challenging near-term new highs become. Cameron joins us now for more. Cam, good morning.
Good morning.
For much of this year, there's been some confusion. Are we starting to see a cyclical rotation? Is this cyclical offense? Now it just feels like AI defense and nothing else. Is that fair?
I think that is fair, because if you break the cyclical rotation into the fact that there are the AI infrastructure beneficiaries, certainly there is a cyclical favor to that. Look at the rally that we've seen in industrials. They're trading at 27 times forward. A name like Caterpillar trading at 32 times forward. That's typically something that we would laud as being a sign of a cyclical upswing. But then look at the financials. The financials breaking down certainly challenges this notion that you are seeing a broad cyclical upswing. For us, the biggest, most important ratio we've been watching is equal weight consumer discretionary versus staples. This ratio has been the reason to be optimistic about the U.S. economy and the U.S. consumer over the last 3 years. It's broken down to start the beginning of the year. It's still technically in an uptrend, but it's not looking so hot. So if we start seeing lower highs and lower lows in that ratio, equal weight discretionary versus staples, we think that it would cause us to become a bit more cautious about the U.S. consumer, and thus a bit more cautious about the U.S. economy, and thus a bit more cautious about U.S. risk assets.
Do you think the bond market is beginning to speak to the same theme?
I think that is the question. Is the 10-year near 4% because we're going to have a productivity miracle that brings inflation lower and allows the Fed to cut interest rates? Or is the 10-year at 4% because people are seeking safety? That's a really big distinction, and I think a very much open question.
How much self-fulfilling pain is going to be triggered by the fear that people have in markets? And I'm saying this because the wealth effect was one of the main reasons why consumer spending, had held up as much as it did. You start to see concerns that, for example, even with the software route, that this is going to cause the lending costs to go up, and that's going to crimp the industry, regardless of whether there actually is some sort of existential fear. I'm thinking of FDR. The only thing we have to fear is fear itself. I mean, how much is that actually a self-fulfilling prophecy right now?
I think that is the biggest question, and we raised that as part of our outlook of worrying about the fact that we've been in a feedback loop positive when we think about markets in the U.S. economy. Stronger markets have led to a stronger consumer, mostly in the high-end consumer, which of course is the top of the K, driving all of that spending. If that positive feedback loop turns into a negative feedback loop where weaker markets then cause people to pull back on spending, which cause further weakness in markets, then that could be the source of volatility. So I don't think that we can underestimate just how important the wealth effect has been allowing this overall economy to levitate. Just look at the fact that you see real personal consumption growing by about 1.5% since April and real personal income falling by 0.5%. The gap between that two, between income and wages, is effectively the fact that people are spending down savings as well as benefiting from the wealth effect.
Yesterday, Priya Misra of JPMorgan was on, and she was saying that one thing about the tariff ruling is it introduced more uncertainty and could potentially crimp hiring on the margins by small businesses, adding to this sort of weight on the overall economy. Do you see that as a likely outcome? Do you see this as part of the reason why people are foreseeing some weakness in the underlying economy?
I think that is already the outcome. If you look at the fact that U.S. corporations, large corporations, were able to expand margins last year in the face of tariffs, which we know were borne by U.S. corporations and consumers, the vast, vast majority of it was. The way we think that they did that is cutting back on labor costs. If your input costs are going up in one place, you will turn to another place in order to be able to defend your margins. So they have been pulling back on hiring, whether it's allowing people to shrink the workforce through attrition, but also turning to firing. So if we think about the consumers bearing the brunt of tariffs, they've actually had a double whammy. Not only have they seen prices go up, but they've also seen a weaker labor market, which brings us back to that point of falling real wage growth, because you get the pressure on wages coming lower because of the looser labor market, and you get the higher prices, and that's how we get to this state where you have seen real wage growth fall.
Sticking with tariffs for a moment, John mentioned how the 10-year yield is snoozy. There's nothing really going on. Will that change if we get refunds, $170 billion worth?
Yeah, let's bring us back to the third quarter of 2023. Treasury Secretary Yellen increases coupon issuance by a mere $9 billion. What does the long end of the curve do? It goes up by 150 basis points. So a really big question is, if you see refunds, if you see a lower revenue from the tariffs, does that put the treasuries back into a corner to have to increase coupon issuance? Now, Treasury Secretary Bessent knows this very well, and he wants to avoid increased coupon issuance at all costs. But we do know that this bond market probably won't welcome it if they are forced to do so.
Why is it not pricing it in now? Because this is likely a very serious scenario towards the end of the year.
Well, because Bessent has talked about wanting to keep issuance still towards the front of the curve. And the fact that you still have money market balances making new highs suggests that there still is demand for those bills at the front end of the curve. If we were to see interest rates at the front end start to fall further, I think it's important to watch those money market balances because they've been the ones who have been hoovering up this bill issuance. If those start to trend lower simply because you're seeing less income coming from high short-term rates, that could be a sign that maybe the Treasury has run its course in being able to push issuance towards the front end.
That's certainly the source of comfort right now in the bond market. It's basically what everybody's writing about. The consensus view is that this will take, one, a long time to play out, and two, if you have to deliver that money back, it's all going to be at the front end. It's all going to be through bills.
And the truth is that Scott Bessent has come out and essentially said this. We have no idea. It could take years. It could take never. And essentially, we're going to do everything that we can. And he's already shown himself to be chief trader in charge. So at a certain point, I think people put a lot of faith in Scott Bessent to maneuver this in a way that's not going to be disruptive.
Bob Michael at JPMorgan joining us to the next hour. No doubt we'll have that conversation with him. Cam's going to stick with us. Cameron Dawson there of NewEdge Wealth. Equities doing OK, positive by 0.2 on the S&P 500 with an update on news worldwide with your Bloomberg brief. Here's Yahira Anand with more. Hey, Yahira.
Hi, John. Home Depot earnings just out. Shares are up 4% in the pre-market. The company reporting fourth quarter earnings that beat Wall Street estimates. Home Depot CFO saying, quote, everything is moving very slowly in the right direction, but we haven't seen a catalyst for a change in home improvement demand. Meanwhile, JPMorgan Chase CEO Jamie Dimon telling investors he's starting to see parallels to the era before the 2008 financial crisis, when a rush to make loans ended disastrously.
Unfortunately, we did see this in 05, in 06, in 07, almost the same thing. The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. They're just doing dumb things to create NII or say they're winning in the markets business, something like that.
Dimon says he expects the credit cycle will eventually sour again, though he is not sure when. $1 million question. And the Northeast continuing to dig out of a powerful winter storm. The blizzard knocking out power to 600,000 homes and businesses, grounding more than 10,000 flights and disrupting intercity rail service. Central Park recording nearly 20 inches of snow. Forecasters say more snow may fall later this week. That's your Bloomberg Brief. John?
Nobody wants it. Yahira, thank you. Thanks for the update. We'll carry on tracking that story for you throughout this morning. Up next on the programme, the AI scare trade making a comeback.
I thought there was going to be a small reaction. It was definitely larger than we expected. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. It spooks people when you do consider what is negative about this.
Up next on the programme, we'll catch up with Anurag Rana of Bloomberg Intelligence, live from New York City this morning. Good morning. Throughout today, tons of Fed speak. Brace yourself for that. Later on this morning, consumer confidence. That's interesting going into this at 9 p.m. Eastern time. The president delivering the State of the Union. Some confusion, some frustration, I think, in the White House as to why the previous read is so low. Consumer confidence rock bottom when they believe this economy is so good.
Well, it comes down to affordability. And the fact is, we talk about inflation with the CPI index and the CPI report. Americans are thinking of price levels. Price levels haven't come down, and you see other areas where prices are going up. Electricity, beef, affordability is huge. That is the North Star for this administration ahead of the midterm elections. And on top of that, you're going to have this angst because basically we're back into tariff uncertainty. Remember everyone said we're peak tariff uncertainty?
Sure.
We're not. We're back to square one, where we have to even understand, is it even this morning 10 or 15%? By the way, it's 10.
And then once you get past the politics and the policy, we can get back to earnings tomorrow after the close. Nvidia on deck. Into that, equity futures positive by 0.2% on the S&P, on the Nasdaq up by a quarter. This from Steve Author, Federated. The first price target cut I've seen so far this year on the S&P 500, down from 7,800 to 7,500. Right, so range of reasons for this. Here's one. The asset-light business model is changing. That paradigm is being challenged. I heard the same thing from Savita Subramanian of Bank of America going into the weekend on multiples. PE should compress more, even in software. Asset intensity and leverage are worsening. That's a big focus for this year.
Evidently, the $650 billion of capex from 4 big hyperscalers resounded across Wall Street and didn't do so that well. And it seems like that has changed people's estimation for how much they can grow into their capital structure.
Let's keep it on tech. Under surveillance this morning, the AI scare trade making a comeback.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And so it, on the one hand, spooks people when you do consider what is negative about this.
So here's the latest this morning. Another wave of anxiety weighing on software stocks following a report predicting an AI-driven recession in just 2 years. Citrini Research writing, in every way AI was exceeding expectations and the market was AI. The only problem, the economy was not. Joining us now, Anurag Rana of Bloomberg Intelligence. Anurag, welcome to the program, sir. It's good to see you as always. I enjoyed the piece from Citrini Research. What if our AI bullishness continues to be right, and what if that's actually bearish? I was surprised by the actual influence it had on stock prices through yesterday. What does that tell you about where we are?
Well, it basically tells me that there is nothing that can change the narrative right now, just because there is so much fear in the market and people don't know how to act. Especially because the fear is not so much about what's happening to earnings right now or the next 12 months, but it's the terminal value of a company. And if you say a particular company is not going to be in existence 5 years from now, it's very difficult to value or price that particular security. And that's what we are facing at this point.
Well, Anurag, let's talk about multiple pressure then. Last year was an earnings-driven equity market, an earnings-driven rally. Do we face the prospect of a multiple-driven sell-off in 26?
Yeah, I mean, this is the vicious cycle, because now what is going to happen is, because of the sell-off in the first 2 months, people are going to stop hiring at that same rate they were last year, which means further compression on sales growth and earnings growth for all the vendors, not just software vendors, but anything that's providing any kind of intellectual capital to these Fortune 2000 companies. So that's going to keep on going down. And people will basically, reflect that as say that this narrative is because of AI and not so much because of the economic conditions.
Anurag Rana of Bloomberg Intelligence. Anurag, thank you, sir, for jumping on following that report on Sunday evening, which whipped this equity market around big time.
If you take a look at some of the stocks that were actually affected most significantly yesterday, they were names that were name-checked in that report. So if people are saying, wait, it wasn't really that work of fiction, well, Capital One was down almost 9%, American Express down more than 7%, DoorDash, all of the ones that they see as being disintermediated. So clearly there's something going on here, and Anthropic just lobbed a grenade in there with IBM, which also was plunging. So definitely a clear and jittery feeling yesterday in markets.
Wasn't it odd that the responses to that research, at least in my experience online, seem to be more vicious than the responses to anything I've heard from anyone else? Anthropic, all the self-interest that I've seen from, say, the Microsoft AI boss in that interview to the Financial Times over the last week. Why was the pushback so much vicious to this piece, which is a thought piece about the future, to some of the forecasts coming out of the companies at the epicenter of all of this?
Because it hit a nerve. Because it hit a deep nerve that people have not wanted to articulate. And there is this existential angst about what happens if this doesn't go well, and if success for AI does not mean success for human capital, for human jobs. And that is something that thought exercise ignited, and is very hard to argue against.
Are you feeling it? Did it hit a nerve?
Well, I actually read it.
I think so.
The truth is, we were talking about it yesterday. It hit a nerve, but it actually made me on some levels more optimistic, because it made me less optimistic when nobody was talking about this and everyone was talking about all of the incredible gains. Even Chris Waller was addressing this.
Sure.
That we're going to get a pace of job destruction that will absolutely destroy any kind of job creation in the near term. Look, we have to deal with that, period.
The heads are no longer in the sand.
Correct.
I think that's good news. Cam Dawson still with us around the table from NewEdge Wealth. Cam, I asked that question to Anurag. I'd love your response to it. We had an earnings-driven rally through last year. Do we face the prospect of a multiple-driven correction this year?
I think that is exactly what's playing out because we're actually still seeing earnings estimates go up for the S&P 500. A quick caveat, NASDAQ earnings estimates on a top-down basis have started to get cut. So not on a bottom-up basis. People aren't cutting their estimates for individual companies, but on a top-down basis, people are growing less optimistic about NASDAQ earnings. That's the first time that has happened without an entire cut to the broad earnings picture, like during Liberation Day, in a really long time. So if we think about it, we've spent the last 10 years effectively arguing that U.S. companies should trade at 30, 40, 50% premiums to their international peers because they are more asset light, they have more recurring revenue, they have higher return on invested capital. All of these questions that we're seeing jostle markets around are effectively challenging that notion about asset-light businesses, about higher ROIC. And this is the market saying that we do not think your earnings power today should be infinitely capitalized into the future at its current run rate.
So that sounds like a paradigm shift, regime change. Is it fair to call it that?
Well, look, the biggest challenge is that regime change looks a lot like a counter-trend rally at the start. And the last time that we saw a massive regime change in markets was in the early 2000s, where you saw international markets best U.S. markets by a significant degree. You saw growth underperform value by over 100%. So the big question is this the start of something like that? We think the key differentiator is that if you go back to that 2000 to 2006 period, it also was about earnings. Value earnings outperformed growth earnings during that time. And so for this to be something that is a true regime change, it has to eventually show up in the earnings.
Let's talk doomsday. I really did enjoy this top piece. It was a really fun one. And the pushback was significant. And it was really interesting to see what some of the pushback was. The biggest criticism was you think that the unemployment rate could get to 10.1% and we don't get some sort of bazooka response on the policy side. It's something, John, you've talked about before. We've discussed here. How much is that the ultimate savior? Is the Fed the ultimate circuit breaker? And they could drop rates to 2% and they could solve any kind of 10% unemployment rates and they could raise taxes on some of these hyperscalers and all of a sudden, voila, you have a better economy.
I do wonder how much the Fed has any ability to be able to stave the bleeding if this doomsday scenario works. Do Fed rate cuts actually change this picture? It would likely need to come with some kind of fiscal policy response. But typically we see the fiscal policy response once you see the bad news happening or some kind of cataclysmic event starting to happen. So the prospect of maybe getting to a 10% unemployment rate in a few years is likely not enough to get Congress to move to be able to justify a fiscal policy response to prevent it.
What do you think the Fed's role is in all of this right now? You mentioned Governor Waller. I have to say, tremendous respect for Governor Waller. Sounded almost confused in the speech just yesterday. I was reading through it about where we are at the moment and what's their role. What is their role?
It's a really good question, and we think that the role has been dampened ever since the pursuit of pushing down using QE to push down long-term yields and term out debt. I think you can argue that this cycle, the economy has been less sensitive to short-term interest rates than it was in prior cycles because of the pushing down of long-term interest rates. So a really big question of what do Fed rate cuts actually do in this environment? What does the Fed's balance sheet do to prevent what could be major disruption from a technology standpoint? I think it remains a really open question. Now, they'll do what they can. So if you were to see unemployment go up in a significant way, they'll cut rates, and they'll likely cut rates to zero, and they'll argue that they should be well below neutral, and neutral is certainly effectively close to where we are today. So we'd get rate cuts, but I don't know how much it would help.
Cameron Dawson, good to see you. Cam, thank you. Cameron Dawson there of NewEdge Wealth. Tons of Fed speak later on today, and I'm sure many of them are going to give a nod to this big theme that's emerging.
And frankly, they're going to give a nod to it with as much confusion as Chris Waller had. He talked about the thing with AI is it's coming at us so fast that it's easy to start seeing jobs that may go away before you see the new jobs that are going to be created. He went on to say, this could just be a different period than I've ever seen in my history, which doesn't really lead us with much clarity.
Crazy. This one's moving quickly. Coming up on the program, Doreen Edelman of Lowenstein Sandler previewing the president's address tonight. Plus, Yahira has your morning movers. Home Depot rising following an earnings beat. Their stock is up by 3%. whipsawed in the previous two sessions. Equity futures this morning positive by 0.2% on the Nasdaq, higher by 0.25% on Friday. The best day in 2 weeks. Yesterday, the worst day in about 11 days. On Friday, led by discretionary. Yesterday, led by staples. Difficult to keep up. That risk aversion driving a bit into bonds. 2s, 10s, 30s looking like this. 10s near the lows of the year at 4.03%. Yields up by not even a basis point this morning. We've not seen a close with a 3 handle since November, but we're getting close.
And it seems to be flirting with that direction as people look to the Fed with some sort of policy response in the wake of some of the employment carnage that some people are mapping out in fiction pieces on Twitter. There is this question about what the response mechanism would be, given the fact that Fed officials themselves seem confused.
All the Fed speak: Goolsbee, Collins, Bostic, Waller, Cook, Barkin. All coming up throughout today. The front end of the curve anchored around 340 to 350 at the moment. 345 as I speak. Yields higher by a single basis point. The front end of the curve. That's stocks and bonds. Let's get you some single names, some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Home Depot. Shares are rising 3% in the pre-market after a solid beat by the home improvement chain as homeowners continue to spend, taking on small projects despite all the issues we've seen in the housing market. But management says that the big remodel is still on hold, going for 3 years now. As for tariffs, the CFO telling us nothing really concrete other than they're analyzing the impact after the Supreme Court, of course, struck down President Trump's tariffs and he issued new ones. They did say that price increases will come in the first half, though those were already planned. Meanwhile, we are seeing shares of Hims and Hers down 6.25% in the pre-market, despite the company giving a forecast in line with expectations. But that outlook relies heavily on the company continuing to sell copycat versions of blockbuster weight loss drugs, which, of course, a business that is now facing lawsuits from Novo Nordisk, plus the regulatory overhang, with the company saying just yesterday that the SEC opened a new investigation. All that hanging over a stock which has lost half its value this year. And the latest AI disruption scare only reinforcing the rotation trade as investors move away from software and cybersecurity names, as we saw yesterday, and move into names like SanDisk, which of course have the infrastructure that power AI. SanDisk, of course, makes memory products. Those products are in shortage, so shares are up more than 140% this year, up another 3% this morning. John?
Yahara, thank you. Thanks for the update. More from Yahara later on this hour. On a radar this morning, a fictional report from Securities Research setting another sell-off in motion yesterday. The Post warning of possible AI risk to parts of the global economy and potential bankruptcies in the software sector. Elsewhere, the JPMorgan boss, the CEO, Jamie Dimon, saying he's starting to see parallels to the era before the 2008 financial crisis.
The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. You know, they're just doing dumb things to create NII or say they're, winning in the markets business or something like that.
Dimon expressing doubt that AI concerns would have a major impact on credit losses and sees his bank as a winner in the AI race. And finally, President Trump's new 10% global tariffs are now in effect as part of the effort to preserve the administration's trade agenda. The White House is working on a formal order to increase the global tariff rate to 15%.
This is the interesting thing. President Trump caused waves in markets yesterday, in part because of the 15% proclamation on Truth Social. The fact that it came out as 10%, really interesting. Also interesting to watch what the response is from some of the companies that are trying to get it back in the wake of this decision.
So basically, FedEx, another one that lined up. You have to be able to go to the lower court of international trade, sue the government basically to even be in line to get part of that $170 billion of tariffs that were paid. That is going to be the big question mark. Do the refunds get paid and who gets them? And then when it comes to actually the trade deals, like the European Union basically saying pause because of what happened with IEEPA, that is another whole basically round of negotiations this administration is dealing with. Jamieson Greer, Secretary Bessent on the phone with their counterparts saying, please, these deals need to stay, as they have this bridge, as they call it, of 122, 10% now, maybe 15% later, depending on if they actually sign that executive order, till they actually do real investigations of 232s and 301s, which have the legal durability to withstand.
Well, let's just sit on the people involved. Would any of this have happened if Ambassador Lighthizer was still running the show?
It's a good question. I would say potentially the president maybe could have been talked into doing the investigations right at the start. But I think they clearly thought that if we make this too big to fail, the Supreme Court has to be on our side, which is, in the end, the gamble they went for. The only reason why I caution on whether or not it happened or not is because the president will make a decision, and there's other voices in the room. Remember Trump won. I don't know if it's happening as much in Trump, too. Remember Trump won. Everyone complained that a decision would be made, and then Peter Navarro would go in and then get the president to reverse course.
Well, let's head down to Washington and get the latest. President Trump preparing to deliver his State of the Union address tonight in front of the Supreme Court justices who struck down his signature economic policy. Box office down on Capitol Hill. Bloomberg's Mike Shepard joins us now for more. Shep, what can we expect?
Well, you know, the president is promising a long speech with a lot of ground to cover. But as we've been just discussing now, tariffs is going to be one of the most closely watched issues that he will bring up. We can expect the president to defend his tariff agenda. It's really the cornerstone of his economic strategy. And to see it kicked away by the Supreme Court was a bitter moment for him on Friday. And we will see him perhaps reenact a little bit of that frustration before the Supreme Court justices in attendance. Beyond that, though, we can expect him to talk about trade partners and how they need to abide by those agreements while the more durable and lasting authorities are pursued to impose subsequent rounds of tariffs to replace the ones that were just voided. We can also expect him to perhaps address in some fashion the affordability question. You know, voters, when Trump is talking about the economy, are not exactly buying it, including on tariffs. The voter approval of his tariff program is underwater. It's below 50%. And voters instead are looking at the economy through the affordability lens. They are seeing grocery, housing, and utility prices much higher, and they are just not getting the sense that they are benefiting from the tariffs and from, more broadly, his economic agenda in the way that the president is presenting it. Now, the president, when it comes to the affordability issue, he has at times called it a hoax. Last week in Georgia, he said that they had won on affordability, pointing to a slowdown in rises in inflation. But at the same time, those issues of grocery prices and utilities really do linger for voters. And we may see him talk about the utility and electricity price question during the speech tonight. One of the issues has been, of course, the rise in electricity prices fueled by the AI boom and the build out of all those data centers, creating competition for electricity. And he may talk about some pledges from big tech companies to make sure that their data centers don't boost utility prices for consumers. All of this, of course, is taking place against the backdrop of the midterm elections, and the economy is going to be front and center, and the affordability at the very heart of that.
Hey, Mike, it's always good to see you. Mike Shepard down in Washington, helping to lead some of our coverage later on this evening ahead of that address from the president. Joining us now to discuss is the chair of the Global Trade and National Security Team at Lowenstein Sandler, Doreen Edelman. Doreen, welcome to the program. Can we just take a step back and start on Friday? And give us a sense of the picture that you're articulating to clients at the moment, what the policy sequencing is going to look like from here.
Great question. So on Friday, it was not unexpected that the Supreme Court invalidated the tariffs under IEEPA, because under the law, it was very clear, at least 6 of the 9 justices agreed, that tariff power is reserved to Congress. The president overstepped his authority. And I think we can even see that with Trump's reaction. He talked a lot about his new tariffs in his Truth Social post and on his press conference, or during his press conference. But he did not say that he was going to challenge the Supreme Court decision. He's going to work around the Supreme Court decision. So we've got that the tariffs are illegal. Therefore, any tariffs will no longer be imposed going forward, and any tariffs that were paid should be refunded, period. That's clear. The court even went on to say that you don't have to have filed a lawsuit in the Court of International Trade or anywhere else to get the refunds. The question comes in, though, is how are the refunds going to be administered? What is the process and what is the timeline? And that is what concerns every company I know.
Well, when you speak to companies, what are you telling them in terms of how they should think about the timeline?
Exactly. We're telling them, use the procedures that are currently available. Under the customs regime, there are procedures for refunds. there's two sets. Because remember, we're waiting. The Supreme Court told the Court of International Trade that it needs to put a process in place so that Customs and Border Protection, CBP, can issue these refunds. So while we're waiting, the existing process is that companies can go ahead and file one of two ways if their goods have not liquidated. And what that means is when you bring goods into the United States, you pay your tariff. But that process is not finalized between you and the government until approximately 314 days later, and that is called liquidation. So if a company has imported goods, but they haven't liquidated yet, they can file what is called a post-summary correction. And that means that we're telling the government we made a mistake. The IEEPA tariffs are illegal. Therefore, we made a mistake in what we paid you and we want a refund. Pretty simple. Sounds pretty simple. It's a typical administrative procedure. That is one thing they can do. The other thing they can do is if their goods have already liquidated, the court has gone far enough to say that we're not going to have that be a problem for you to get refunds. So because if your goods have liquidated, you can file another document called a protest. And again, you're going to say that the tariffs were illegal and we want a refund, and here are the documents showing we deserve it. Now, in theory, that is how it's done. The problem is that obviously millions of companies are doing it, and there are no time limits. On a PSC, it could take up to 314 days to get you that refund. When you file a protest, the government has 2 years to respond. So in this case, you have an administration that really doesn't want to roll back these tariffs. So
Doreen, it doesn't sound simple. If I could just jump in there, it sounds what Justice Brett Kavanaugh said on page 64 in his opinion. This is going to be an absolute mess. While we deal with that potential mess of refunds, and the administration is talking about this bridge to investigations, can you tell us whether or not you think using Section 122 is also even legal? And if we have another Supreme Court decision ahead of us?
I think there will be challenges. But again, that is going to take time. And those 122 tariffs are only good for 150 days, July 26th, and then they need congressional approval. So they can be challenged on the legality, but that is not going to change the fact that any importer is going to have to pay them starting today and through July 26th.
Doreen, it's always good to hear from you. Thanks for jumping on for us this morning and breaking things down. Doreen Edelman there of Lowenstein Sandler on the tariff effort down in Washington, D.C. In an ideal world, this is what businesses want from policymakers. Reduce friction in the economy, one, and two, make sure you dampen down policy volatility. We're achieving neither in the last 12 months with this effort.
Yeah, the idea that peak tariff uncertainty was behind us was really key. And we might have seen peak tariffs, but the uncertainty itself is leaving a lot of businesses in the same place that we started, which is, what do you want from us over the next year, 2 years? We already changed our supply chain once. Just give us consistency.
I caught up with Mohamed El-Erian over the weekend and talked to him about this. And he basically said, sure, at the macro level, things are unchanged. Yes, the average tariff isn't going to change too much. At the micro level, to your point, individual companies just sort of dazed and confused need to figure all of this out now in the next few days and weeks.
It's going to be nice, big, fat lawyer fees that are coming up for these companies, or maybe they can use an Anthropic plugin to figure out what avenue it is. But listening to Doreen speak about the advice she's giving to companies, it depends whether or not your tariff was liquidated or not. Was the tariff even paid? The government might have 2 years to pay it out. This is going to be highly disruptive for the next few months and for the rest, really, of the Trump presidency.
Messy, a real mess. Futures this morning, positive by 0.1% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg Brief. With more, here's Yahira. Hey, Yahira.
Hi, John. Anthropic is offering some current and former employees the opportunity to sell shares at a valuation of about $350 billion. Sources telling us here at Bloomberg, the sale allows them to cash in at the level of a recent $30 billion fundraising. Anthropic's latest funding round valued the company at $380 billion post-money, including the cash investors put in. Paramount Skydance has raised its offer to buy Warner Brothers Discovery. Sources telling us here at Bloomberg the new unspecified bid improves on Paramount's $30 a share proposal made back in December and addresses some concerns around financing. If the Warner Brothers board decides a new offer is superior to its current agreement with Netflix, the streaming giants will have 4 days to respond. Quite the bidding war. And President Donald Trump invited both the men's and women's gold medal hockey teams to attend the State of the Union. The women's team declined, while many of the men's team are planning to attend. You can watch Bloomberg's coverage of the State of the Union starting at 8 p.m. Eastern. We'll have full coverage and analysis of the president's speech, plus the Democrats' response. That's Bloomberg Brief. John?
The men's team's still celebrating, aren't they?
Yeah, in Miami.
My goodness, those guys aren't going to stop.
They went right to Miami, and then in this phone call that was on Twitter, the president was like, don't worry, we'll get you a plane. How about you guys come to the State of the Union? And I think the women's team might not be coming because the president almost like half-heartedly invited them.
It wasn't a full embrace.
It was like, because you're coming, I have to invite the women.
Let's put it that way. Congratulations to Team USA on the event over the weekend. Up next on the program, testing independence.
You recently said, and it's all over the media, that you intended on completing your mission.
That's my baseline, yeah. Independence ultimately has to live in the culture and conviction of the people who serve these institutions, because sooner or later, the legal limits will be tested.
Up next, we'll catch up with Jane Foloey of Rabobank, live from New York City. You're watching Bloomberg TV. All is calm at the index level, and to be fair, that's been the story so far this year. Just hasn't been where the headlines have been. The equity market on the S&P 500 positive by 0.1%, around 2% from all-time highs, believe it or not. On the Nasdaq, up another 0.2%. Turn to foreign exchange, not talked about much, but the dollar just had its best week of the year so far. Against the euro dollar, negative at the moment by not even 0.1%. 117.80 is just a bit of euro weakness begins to creep in. Under surveillance this morning, testing independence.
You recently said, and it's all over the media, that you intended on completing your mission.
That's my baseline, yeah. While we need legal frameworks to ensure central bank independence, frameworks alone are never enough. Independence ultimately has to live in the culture and conviction of the people who serve these institutions, because sooner or later, the legal limits will be tested.
So here's the latest this morning. The ECB President Christine Lagarde is touting the importance of central bank independence while downplaying reports that she will leave her post early and influence who names her successor. Jane Foloey of Rabobank saying an early Lagarde exit is the best case for the euro, writing, by denying the next French president the ability to appoint the next ECB head, Lagarde could remove what could otherwise be a period of downward pressure. Jane joins us now for more. Jane, welcome to the show. Just explain your thinking just a little bit more. Is this actually a legitimate concern weighing on the euro at the moment?
Perhaps not in regard of Lagarde alone, because we've got to remember that Lagarde isn't the only, or her seat isn't the only one that will become available next year. We also have Lane, we also have Schäuble. And I think the combination of those three seats becoming vacant, that's where the pressure potentially lies. So with respect to Lagarde alone, we've got to remember that all of those seats will be appointed not by the French president, of course, but by a council, which will be around about just over half of EU members. So that there isn't the ability of the French president to really have as much sway as he wants. Nevertheless, the fact that Lagarde is talking about this really does underpin that there is the issue of independence. Who is going to get those seats next year? To what degree will the new French president want to have his say? It will be part of those discussions. So really, it's all three of those seats. Where do they go? If not joins in, that's a possibility. There might be 4 vacant seats. So the issue of ECB independence will be, and we've already heard, is already topical.
Jane, we've been told repeatedly, and I think we all believe in central bank independence, and we all agree that if you diminish that, erode it, that it's bad for the currency. There is an argument that if she looks to influence who replaces her because she likes who's in power now and what might not come next, that would be eroding central bank independence and should be bad for the currency.
Well, that's exactly right. And probably that's precisely why she's saying, you know what, I will stay to the end of my term, because she doesn't want to be seen as playing those political games. So that is indeed part of that. But we've got to remember, you know, we do have this issue now, or we've had for a while now, the issue of potential loss of some of the Fed's independence. Right now, again, we see this noise this morning in Japan. You know, the market is fairly convinced that the Bank of Japan is losing some of its independence, although that hasn't really been proven at all in terms of what's happening in Bank of Japan policy. And the market will be nervous next year with respect to what is going to happen with respect to the ECB. It's unlikely, you know, in our view, that France will get to appoint the next president, but usually France and Germany tend to have a permanent seat on that 6-member board of the ECB, and it is likely that there will be another French position in that board. So perhaps that's where the focus lies. We've already seen, for instance, last week Spain announced that it might be interested in putting forward a candidate for the presidency of the ECB. But of course, as we've just discussed, that has to be backed by a broad member of the council in any case. So lots of cards up in the air, but I think independence is going to be an issue that we will be focusing on in the months ahead.
What's the policy implication, Jane? Is it that there will be a global rate cutting cycle that might not cohere with what the economics warrants? I mean, what is the ramifications of a loss of independence globally?
Well, if we go back to the comments that were made by the French far-right potential candidate for the French presidency next year, we heard him say that he wants the ECB to restart quantitative easing and buy French debt. Now, clearly, there's credibility issues in there. There's currency issues in there. There's inflationary issues in there potentially too. The reason, of course, that he would probably want the French central bank or the ECB to do that would be perhaps to take some of the pressure off his fiscal policies, to try and allow him to maybe write a few checks, run a looser fiscal policy. We do have these issues, of course, with respect to the budget in France ongoing. We have difficulty in France agreeing or getting the mainstream politicians to agree to allow people to work older, for instance. There's a lot of pressure on the budget from that. But of course, if that were to happen, and nobody's arguing that it definitely will, but if those sorts of policies would happen, that would certainly undermine the value of the euro going forward.
And Jane, just quickly then, 117.81 in 30 seconds. Where next for this one, for this currency pair?
You know, I think it's just choppy. There's so much of an onslaught of news flow. We've had this so far this year. I think we're going to continue getting this year. We've got, obviously, Friday's news about the Supreme Court, but equally, we've got news going on about Iran. We've got news going on about AI. So there's also, you know, a safe haven bid potentially supporting the dollar, just as people are worried about long-term investment projections in the US because of these political uncertainties.
Hey, Jane, good to catch up. Thanks for the reaction there. Jane Foley there of Rabobank. The story that just won't go away. What does it mean to say it's in your baseline? You know, don't you just commit to completing your term? Why do you have to keep on saying it's in my baseline? What does that mean?
It means that she doesn't really want to commit to anything, and it means that we have no clear sense. I mean, look, I think that the bigger implication here is that people have gotten short the dollar because of a loss of Fed independence, but this is a story globally, and that really is going to potentially pressure other currencies as well.
It's in my baseline to complete the show today. Is it in yours?
Keeping your options open.
Yours?
I'm not sure, John.
Let's see. All right, coming up next, Bob Michele at JPMorgan, Libby Cantrill of Pimco, Daan Struyven of Goldman Sachs, Craig Siegenthaler of Bank of America. From New York City, you're watching Bloomberg TV.
There are signs of stress in the equity market.
The market's going to tread, down a little bit.
I wouldn't be surprised if we start to see a little bit of move back into tech.
Eventually, investors will go back to tech.
There's just a tremendous amount of dissonance right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. A choppy few days, a choppy few weeks. Equity futures this morning positive by 0.2% on the Nasdaq, up by a third. In the bond market, all is quiet this morning. Yields very, very close to the lows of the year, 4.03% on 10s. Later on this morning, some economic data, consumer confidence, look out for that. Then this evening, an address to the nation from the President of the United States.
So my question is, how long is this thing going to be? He already said, look, this is going to be a really long speech, and he has given a speech once that was 1 hour and 39 minutes or 99 minutes and 32 seconds, according to the record. How much is he going to lay out a litany of potential issues in addition to the affordability concerns that a lot of people have been expecting?
And it comes at a time when you have still part of the government, when it comes to DHS, that is technically not being funded right now. There is like that part of the government that is still technically shut down. And the president's approval ratings really are at a low. Only 39% of Americans approve of the job he's doing right now. And the issues he won on, he is underwater when it comes to affordability as well when it comes to immigration. And tariffs will be front and center given the fact that not only did we get that Supreme Court decision, the president yesterday was out with, I would say, a bit of a petty Truth Social post saying he's not even going to discuss the Supreme Court or write with them with capital letters because that's how annoyed he is. Well, those justices will be front row. It's going to be acrimonious.
I imagine he's going to highlight where the equity market is as well, very close to all-time highs. But the disruption beneath the surface is something we'd love for the administration to address. Let's talk about that disruption and a deal just announced. This from Ian King of the team here at Bloomberg News. I'll read it verbatim for you. The Meta will deploy 6 gigawatts worth of data center gear based on processors from AMD. They're calling it a blockbuster deal that marks a win for the chip makers' attempts to catch up with NVIDIA. AMD in the pre-market up by close to 11%.
Yeah, this to me is actually really interesting because you would expect that AMD, Broadcom, Micron, in addition to NVIDIA, would be the beneficiaries of the dystopian future that we were talking about just moments ago. And yet yesterday, a lot of those names sold off. Today, you're seeing a pop. How much are the hyperscalers going to be on the hook to pay for all of these costs? That's going to be increasingly a focus. And how much are they going to come out with these deals to show, look, this is going to be our money, so you don't have to worry about the populist outrage.
Big move in AMD, but to your point, the semis should be winning all of this. $600 billion north of capex intentions from the big four, and yet the rally of NVIDIA has absolutely stalled, and that arguably is the headline going into that earnings report.
Yeah, what does NVIDIA have to show to disprove that narrative? I'm curious about their CapEx plans. How much capital expenditure do they plan to engage with? Do they signal any slowdown in demand? It doesn't seem like that based on the hyperscaler plans. But you're right. I think that ultimately, if you believe that AI is going to win and human capital is going to lose, well, AI should at least get some benefit in terms of the share prices. And why are we not seeing that when it comes to some of the hardware?
Until we start taxing them because unemployment's in double digits and, we say 50% of the earnings of chip makers.
Would it be chip makers,
to fund
though?
UBI?
No, because they're strategically important. UBI is going to come from Microsoft.
Well, already the president is saying that they need to pay some of this electricity build out because that is causing higher costs for consumers. So I can expect potentially he's going to push them to pay for a lot more than that.
You can get gloomy so quickly with this story. Good news for AMD. The stock is up by 12% in the pre-market. Equity futures a bump higher, up by a quarter on the S&P. Coming up this hour, we'll catch up with Bob Michele at JPMorgan with bond yields near new lows for the year. Libby Cantrill at Pimco as President Trump prepares to deliver the State of the Union address. And Greg Siegenthaler of Bank of America on an attractive buying opportunity in Blue Owl. We begin this hour with stocks creeping higher following another AI scare. The latest bout of risk aversion helping to drive bond yields down towards new lows for the year. Bob Michele of JPMorgan Asset Management writing, the US economy continues to operate at trend with continuing disinflation. Tax refunds and AI capex are nice tailwinds. All of this is good for the bond market. Bob joins us now for more. Bob, good morning.
Happy to be here.
Bond yields, new lows for the year. Very close to those levels right now. What's driving yields that much lower?
I feel that the bond market is sitting here with a growing stack of chips. We're getting all the chips from private capital and from equities where a lot of investment by clients has gone. As I talk to our clients, they still feel underallocated to fixed income. Our message is, come on in. We're great. We're the perfectly priced market. If I think about the Fed funds rate at 3 5/8, I like it. Even if inflation runs at about 3% this year, you're talking about positive real yields on Fed funds of 0.5%. You look at the 2-year Treasury, it's near the Fed funds rate. That looks pretty good at 340 or so. You've got about 60 basis points of steepness out to the 10-year. That looks reasonable to us. You're just over 4%. You look at credit spreads, for an economy that continues to expand with some tailwinds. They look fair to us.
There's been some doubt, as you know, about how bonds would perform in an equity correction. Are we beginning to prove the doubters wrong with recent price action?
I think so, and I think we've long talked about the long end becoming unanchored seemed to have gotten overdone, that the pain trade for this year was going to be a bullish flattening of the yield curve. We're starting to see that now. Investors are recognizing they can go into bonds. There is yield there. It is the counterbalance to risk.
When you say go into bonds, you're talking about treasuries. You're talking about long end and you're talking about short end. Does this kind of rally in the government bond space mean something bad for the riskier space?
I'm talking about the entire bond market. I think most of the client base that's coming into the bond market isn't surgically thinking about treasuries versus credit. They want to buy an aggregate bond fund, a core plus bond fund, an income fund, a bond opportunities fund. In those benchmarks, there are going to be a lot of treasuries, but there's a lot of credit. That money is coming in and it's buying all sectors of the market. I'm not worried about credit here as long as recession isn't on the horizon. And right now, recession seems a long way off.
Your CEO is talking about how there are some problems brewing and there are people acting in irresponsible ways in order to get extra net interest income. There's this feeling that maybe there is a canary in the coal mine that is mounting in private credit. We did see high-yield bond spreads blow out a little bit yesterday. Do you see any issues percolating there?
Your producer promised me no hard questions today.
You did. No one told me, so
No
I didn't get the memo.
ever.
Look, I have a lot of sympathy for Jamie's view. One of the things that we've been looking at is CLO equity prices and how those have dropped. For those of us who have been around for a long time, it's reminiscent of what we were watching in the 05 to 07 period going into 08. There were things called asset-backed securities, CDX, so indices. And if you track the BBB minus portion of that, which held in for a long time, they also plunged. So it's looking like the first loss pieces of structured credit, much like that 05 to 07 period, are starting to crack. Now, history doesn't perfectly repeat, but it rhymes. It's something to keep an eye on.
Do you see them as liquidity issues or asset quality problems? Is it one or the other right now?
It's a combination of both, right? Because as loans are created, depending where they're created in the broadly syndicated loan space or in the private credit space, there's a different specter of liquidity on them. And where they go, do they just sit in portfolios and roll over? Do they go to create credit enhancement for CLOs? Those are also structuring problems. So I think it's a combination of both.
I'm going to avoid naming the names so you can actually talk about it. So if a fund comes out and has to send a portfolio of loans, has to sell them, and they get sold really close to par, does that end the idea that these assets aren't marked properly? Or does it just make you ask questions about what the other assets look like?
It tells you that things are functioning okay right now for the first movers. I think that's good. I think as long as the economy continues to move along at trend or higher, I always say a rolling loan gathers no loss. Those loans will be rolling. And then the amend and extend and the restructurings that are going on behind the scenes, they'll continue to go on behind the scenes. That's fine. I think what everyone's worried about is we haven't had a shakeout in private credit yet. And a recession is that ultimate shakeout.
Do you prefer liquid credit right now to private credit as a result of that dynamic?
I think it all just comes down to the borrower. I don't mean to evade that, but ultimately, if you're a credit picker, you've got to examine the borrower, and no two borrowers are identical.
So you're very constructive, unlike maybe other people that we heard yesterday from JPMorgan. But you did say in your note that there is a new level of geopolitical and economic uncertainty given what the administration is doing, fighting back after IEEPA was struck down. Why is that, though, if they're just filling the hole with another 10% tariff level?
Because of all the confusion it creates for corporate America. If you've paid the tariffs, you're entitled to get that money back if they were IEEPA tariffs. So you've now got to go through the process of reclaiming that. It's not quite clear what new tariffs will look like. Yesterday, the thought was 15%. That was just mooted. They're actually 10% with the threat of 15%. We don't know what the sectoral tariffs are like. When we talk to the businesses that we extend credit to, they seem to be frozen again, just as they were starting to understand what the cost of tariffs would be and the impact of AI, what happens in the last couple of days. Both of those become news items again, and it kind of freezes them from thinking about CapEx in the coming year.
Freezes them potentially also from hiring. Is that an issue right now you think corporate America is dealing with?
Yeah, when you look at the stasis in hiring, it's been that low fire environment for exactly those reasons. You didn't know what your profitability would be after tariffs. Just as you were starting to get through that, we're going to have a new round of tariffs. And of course, there was always AI out there. You didn't want to hire a load of people if in 18 months you had to replace them. And just as they were starting to understand that, there's more noise there.
Bob, we've known each other a long time. How many times have we had 10-minute conversations about fixed income without talking about the Federal Reserve? How new is that?
It's a welcome reprieve from talking about that.
Is that the same with clients at the moment? They're not asking about the Fed in quite the same way as the story shifted?
No, they're still concerned about Fed independence. They're still concerned about the nominated Fed chair and what that will look like. They're still expecting multiple rate cuts this year. So clients do still talk about it a lot.
Emphasis on nominated. What do you mean by that?
Well, he has to get through the congressional approval process. We'll see if it happens. I think it was a pretty clean pick. You have someone who was there 12 years ago, who has a body of work, looks like a very good candidate to us.
You say if. I would say when. We'll see when it happens. But you say we'll see if it happens. If you've got doubts that it happens at all.
Yeah, Congress, I'm probably in the 80-20. It will happen.
Sure.
But there's got to be some noise along the way. When you look at what's going on in Congress, what's going on in the administration, the midterms coming up, and the new Fed chair would take their seat in May. That's getting pretty close to electioneering for the midterms. I think it could become a political event.
Interesting, Bob. It's good to see you, as always. Thanks for dropping by. Thank you. Bob Michael there of JPMorgan Asset Management. Didn't expect the headline to be on the Federal Reserve at all, but right at the end there,
either did
it's
I.
an if.
Especially when it was basically to the date, February 16, 2006, Kevin Warsh got a voice vote of yay to go through. And now you have someone that's emphasizing his nomination and the noise surrounding the fact that potentially this hearing and vote on the Senate floor can be a little bit more chaotic than many were expecting.
Bramo, the calendar is still empty. Still waiting to see when or if that even happens.
The interesting thing is people don't care. If you actually are looking at markets, and I think that that's the more interesting aspect here, what is the Fed going to do to alter what is going to be potentially a seismic change in the structure of the economy? They don't have a clue. We don't know who the composition is going to be. But even if we did, do we have a sense of what the response function is?
Bond yields near the lows of the year. Against that backdrop, 10s at the moment, 4.04%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. In a blockbuster deal, Meta will spend billions of dollars on AMD data center gear over the next 5 years. Meta will also receive warrants to buy 160 million AMD shares. Those shares will vest, and when the project and AMD stock price reach certain milestones, turning Meta into a major holder. Just last week, Meta announced a tie-up with AMD rival NVIDIA. The Ukraine war entering its 4th year. Peace talks and fighting are largely at a stalemate, allies saying President Trump is pushing for a deal before the U.S. hosts its 250th anniversary celebration in July. There's no indication Russian President Vladimir Putin is ready to reach an agreement that doesn't grant his central demands. And the Northeast digging out from what meteorologists are calling the biggest storm in a decade. More than 2 feet of snow falling in parts of the region. The highest wind gusts topping 80 miles per hour in Nantucket. Plane and train service is still seeing massive delays and cancellations. And the National Weather Service tracking another storm Thursday afternoon into Friday morning. That's your Bloomberg Brief. John.
You sound how so many people feel right now about that. Yahara, thank you for the update. Up next on the program, ramping up Supreme Court attacks.
Supreme Court's ruling on tariffs is deeply disappointing, and I'm ashamed of certain members of the court, absolutely ashamed, for not having the courage to do what's right for our country.
Up next, we'll catch up with Libby Cantrill of Pimco, live from New York City this morning. Good morning. Stocks are positive by 0.2% on the S&P, on the Nasdaq up by 0.4. The Nasdaq getting a lift from this. Check out AMD in the pre-market, absolutely flying off the back of a big commitment from Meta to buy AI chips and computers from the firm over a 5-year stretch and receiving warrants to buy 160 million AMD shares.
What took so long? I think that's my question, given the fact that if you look at some of the CapEx plans, it's going to be going to potentially NVIDIA and it's going to be potentially going to AMD and on a lesser sense, Micron. So at a certain point, you have to wonder, why are they not benefiting? Why are they still so far away from their all-time highs?
AMD up in the pre-market by more than 12%. That is a big move. The next stop, of course, for big tech is tomorrow after the close when we get NVIDIA earnings. Later on, though, this evening, all attention is on Washington, D.C. Under surveillance this morning, ramping up Supreme Court attacks.
Supreme Court's ruling on tariffs is deeply disappointing, and I'm ashamed of certain members of the court, absolutely ashamed, for not having the courage to do what's right for our country. They're very unpatriotic and disloyal to our Constitution. It's my opinion that the court has been swayed by foreign interests and a political movement that is far smaller than people would ever think.
So here's the latest this morning. The president preparing to deliver the State of the Union address tonight. And some of the Supreme Court justices who struck down his IEEPA tariffs are expected to be in attendance. Bloomberg's Mike Shepard joins us now for more. Shep, just how awkward is this going to be later this evening?
Well, it could be a little awkward. And John, really, this has been an interesting side drama in the whole saga over tariffs and Trump's bitter defeat at the High Court last week. It was very clear on Friday his frustration with the Supreme Court overall with the decision, but specifically with the justices who ruled against it, who included 2 of the 3 he appointed to the Supreme Court during his first term. Now, the backdrop to this is not just tariffs, John. It really has to do with some of the other key issues that the court is going to be adjudicating that are also pillars of the administration's policy. One is the president's declared authority, in his view, to be able to oversee independent agencies, and that includes the Federal Reserve, and the question of whether he can at will fire members of the court. And that includes the Lisa Cook case. And then we also have the question of birthright citizenship, both of which came up in the Truth Social post yesterday. We'll be watching this speech for more of that tonight.
Looking forward to it, Shep. Thank you, buddy. As always, Mike Shepard down in Washington. With us here in New York, Libby Cantrill of Pimco. Libby, good morning.
Good morning.
Set the stage for us later on this evening. Just how bad is this going to be for the Supreme Court?
Well, it could be tense. I mean, I think if you compare this to his joint address last year, which was triumphant, he had a positive net approval rating. He had 2 chambers of Congress. He was going to pass this big tax bill. He had this long runway. Now, politically, a much shorter runway, a net negative approval rating. And then, of course, this sort of, awkward type of situation where the Supreme Court folks are going to be sitting in the front. I think we're going to try to hear him really try to lean in to the victories that he's had over the last year, trying to remind folks that he did pass this one big, beautiful bill that, of course, people are going to start seeing in their refunds. I think he's going to lean into immigration policy. That's one, except for over the last 6 weeks or so, one where he's actually been net positive in terms of polling. And then we may hear him on Iran as well. But in general, we should expect a long address. Last one was 90 minutes. This could be even longer. And one where he's really trying to make the case to the American people about why they should be approving of him, probably in a little bit more positive way, but also importantly, when they go to the election in the midterms, that they should be voting for a Republican.
He has warned us that it's going to be a very long one. But when it comes to the Supreme Court and the tariffs, it didn't have to be this way. Why, in the end, did they decide to go for IEEPA, even though they knew that this was going to have a tremendous amount of issues potentially at the Supreme Court?
Well, I think that, the Justice Kavanaugh, of course, who was in the dissent, but he even said that it was really not the issue for the Supreme Court to try to navigate how onerous the refunds would be, that they were, their job, of course, is to interpret the law, and at least for 6 of the 9 justices, that was pretty clear. And I think that the thing for the markets in some ways was it was very unequivocal. This was a really clear opinion that actually it is Congress that has the power of taxation. Maybe the president has the power of regulation as it relates to foreign policy, but in terms of taxation, that power still rests with Congress. Now, I think actually, even though there's a lot of uncertainty here in the short term around tariffs, longer term, this is a good thing, I think, for markets, because this is just reinforced that, yes, the separation of powers still exists, I'm not actually trying to be flippant. I mean, that this is just, very clear in terms of actually who holds the power of the purse, and that is still the Congress.
If USTR and commerce investigations aren't done by the end of the 150 days of using 122, does Congress take that up?
I think Congress will try to avoid taking that up. As Annmarie probably knows, July 24th, which is the deadline, which is when these tariffs actually set to expire, is also the beginning of the summer recess for Congress. So I think they would much prefer to try to head out of town, go and to their districts and campaign for the midterms. I think that it is very unlikely that they even try to take this up. I think if they do, this vote will likely fail. This does not have 60 votes in the Senate, does not have 218 in the House. This will fail, and this will be, could be an embarrassment for the president. So I think very unlikely that you see Congress actually voting on this.
Forgive me for the stupid question, but is it 10% or is it 15%?
I had to check this morning as well. Of course, we thought it was going to be 15%, but as of midnight last night, what is actually being implemented is 10%. Now, I don't think anybody should get too comfortable with that number. Of course, the president has the ability to go up to 15% under the statute of Section 122. He, of course, said he is going to do that on Saturday. So I think this is more of a question of when, not if. But it is a little confusing, given what President Trump had indicated. I think the other thing, again, from a market's perspective, is even though we have this intervening period of uncertainty, going forward, we're no longer going to have trade policy by tweet. This is because IEEPA really was the statute that allowed the president to do that. These other tools, Section 232 and 301 and 201, they're clunky. There is a process. There is an investigation as it relates to it. So in some ways, even though, again, there's a lot of trade policy uncertainty right now, I think in the longer term, this actually should mitigate uncertainty once we get to that point.
Refunds could be messy. Is it a non-event for the market? Most people assume it is. What does the team at Pimco say?
It doesn't seem like it is, right? I mean, you saw a little bit of steepening, when these headlines came out on Friday. But I think that, more or less, the market is expecting for the president to be able to reassemble that tariff, the tariff rate and what have you. And, $175 billion, it's not for nothing, obviously, on a $2 trillion or so deficit figure. But I think in the grand scheme of things, it's also not that significant. And, of course, the administration has indicated that they're probably going to slow walk these refunds. This is not going to be, even if the courts say that this should be more automatic, the process is going to be more clunky.
What did the president say? It could be in court for 5 years.
Yeah. Oh, he's saying it could be in court forever. Brett Kavanaugh says it's going to be a mess in his dissent.
It sounded messy already.
It is messy. I mean, when you hear Doreen talk about what she's describing to clients, it sounds like an absolute disaster.
Libby, good to see you, as always. Thank you. Thank you very much. Libby Cantrill there of Pimco. The takeaway also from one of the Conservative justices, Gorsuch, making the point that if we end up essentially with a socialist president, you'll be happy.
Yep.
That this exists.
This was
my words, not his, but ultimately that's what he's alluding to.
Major questions doctrine. How much power does the executive branch really does have?
Coming up on the programme, Daan Struyven of Goldman Sachs raising his crude forecast. That conversation just around the corner. Last week, the best weekly gain on the S&P since early January. Friday, a decent day of gains. Monday, we took it all back. Equity futures this morning, positive by 0.1% on the Nasdaq, up by 1/3. Some big movers out there, including AMD. So let's get straight to it with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. It's news that broke not that long ago. It is a huge deal between AMD and Meta. Meta is going to be building a 6-gigawatt data center, and they're going to be doing that using all AMD processors. Lisa Su, the CEO of AMD, saying that it is a deal worth multi-billions worth of dollars. And then along with that, Meta's also getting warrants to buy shares of AMD, so a lot to like if you're an AMD shareholder. Shares up 11% in the pre-market. Meta dipped slightly, about 0.75%. We also, in the 6 a.m. hour, had earnings out from Home Depot and SanDisk shares also moving higher this morning. Those are up about 3.5%. Finally, we wrap it up this morning with Planet Fitness. Those also had earnings out. Profit was better than expected. Profit missed estimates, but they did have better than expected otherwise sales. So it's the profit that's an issue. They're spending more on capital expenditures. They're opening up more branches. So that ate into some of those results. Shares down 5% in the pre-market, John.
Hey, Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, another blockbuster AI deal. Danny was just talking about it. Meta agreeing to spend billions of dollars on AMD data center gear, including chips and computers, over the next 5 years. Meta will also receive warrants to buy 160 million AMD shares. Elsewhere, IBM suffering its biggest one-day decline in more than 25 years. Shares sinking after Anthropic's latest tool can help modernize a data programming language that runs on IBM computers. IBM was down hard at Monday's close by 13%. And finally, FedEx is suing the US government. The company is demanding a full refund for the tariffs it paid, which were deemed illegal by the Supreme Court just last week. FedEx saying it, quote, suffered injury by being forced to pay a substantial amount of duties on imported goods.
So this is the first of the big companies, and it's not going to be the last. We already have seen similar types of filings from companies including Costco, Revlon, Bumblebee, Kawasaki Motors. A real question here about what their remedy is going to be. Let's say they get some money back. Does it go to corporate profits, or does it go back to lowering prices for consumers, and how will that play politically? So still a lot of questions. Nonetheless, the lineup is beginning, the fight is beginning, and let's see how it shakes out.
I think we know how some of it might play politically. I'm pretty sure if corporations don't lower their prices, this administration is going to come out and use the bully pulpit. I think the Treasury Secretary called it corporate welfare. So this is going to get messy, not just in the refund process, as all this now moves to the Court of International Trade in New York to figure out the timeline for all this, but also the politics of it and the rhetoric surrounding it.
They don't want to be in the political firing line, but ultimately they have a duty to shareholders to pursue the refund. Absolutely. And to do this publicly as well. You've got to do it.
Ultimately, the question is just whether someone might find it feasible to sell the claims to somebody else at a discount, get the cash, have some certainty in their business plan, and then move forward. Or do they want to make a stand and say, look, we are going after this without a clear sense of exactly where that money is going and without a clear sense of what the future tariff rate is going to be. Look, this is going to be so messy. And how they position themselves and what the messaging is from the corporations will be interesting.
That's the latest from FedEx and those refunds, which could be very messy. Let's turn to crude oil, holding near a 7-month high as investors weigh potential US-Iran nuclear deal, with talks set to resume on Thursday. Daan Struyven of Goldman Sachs writing, although we assume no Iran-related disruption to supply and maintain our 26 surplus, we raise our Brent WTI forecast for the fourth quarter of this year by $6. Daan joins us now for more. Daan, welcome to the programme. We've seen issues with Iran before, and we've got over them very quickly. Why is this different?
Yeah, so far, and it's not all that different from what we have seen over the last few years, where actual Iran crude production remains unaffected, where production in the broader region in the Middle East remains unaffected, but where the market, and I think appropriately so, is putting some weight on disruption scenarios and is pricing in a geopolitical risk premium that we now estimate at around $6 per barrel. The two reasons we look for a decline in Brent from around 71 now to 60 by the end of this year, in our view, the bottom of the cycle is, one, the assumption that easing in geopolitical tensions gradually reduce this risk premium. And second, because we still look for a global surplus, we expect the fair value for oil prices to moderate by about $5 to $60 by the end of this year if we see builds in OECD oil stocks, which, to be clear, we haven't really seen over the last year. We have been in a large surplus, but so far the builds have been happening outside of the OECD pricing centers.
Dan, can we just sit on that, just how well supplied the oil market is right now?
Yeah, so we estimate that in 2025, the oil market was in a surplus that was sizable, in the tune of 1.7 million barrels per day. That is just under 2% of the global market. For this year, we're looking for a slightly larger surplus, 2.3 million barrels per day. Why? The first reason is we think that we started 2026 with excess supply, because in 2025 we had supply outpacing demand. And second, in 2026, we look for strong supply growth in the tune of 1.8 million barrels per day year-over-year growth to outpace pretty robust demand growth of around 1.2 million barrels per day, under the critical assumption that we don't see supply disruptions. While the global surplus is the starting point for our forecast, I think the bullish surprise over the last few months has been the composition of where those inventory builds have happened. They have happened to a large extent on water, where a lot of sanctioned barrels are stuck from Iran and Russia. They're not competing with commercial barrels in pricing centers, and also in SPR facilities in emerging markets.
Dan, today we have Marco Rubio, the Secretary of State, briefing House and Senate leaders at the White House at 3 p.m. There's a lot of obvious people thinking that this is about how Iran is looming large right now, especially ahead of the State of the Union. So what if we did see an actual strike and Iran responded with the closure of the Strait of Hormuz? Can you give us that scenario in terms of what it means for oil prices?
Yes, so I think the critical question for oil prices fundamentally is, do we see disruptions to production and to exports in the region? A 1 million barrels per day sustained supply disruption boosts the fair value of oil prices by about $8. If we were to see a large and full closure of the Strait of Hormuz, prices could be significantly higher. We estimate that prices may rise, to $100 per barrel if you saw a short full closure and then followed by a partial, more sustained closure. But because the economic costs from the rise in energy prices, both crude and global gas prices, would be so large, rational economic reasoning suggests that this is not in the interest of the US, China, the Gulf states, nor Iran. And so that's why we characterize this as an unlikely tail scenario. But risk managers, traders, they have to think about the probability of that scenario, even if it's an unlikely tail scenario, and have to continuously reassess the probability of that tail as a function of geopolitical headlines.
Right. There's also irrational actors in this. We have been in a scenario in the past where proxies of Iran have hit, say, Saudi Arabian energy facilities. What kind of impact on prices would that mean?
Yes, I would refer to our modeled estimate that a sustained 1 year, 1 million barrels per day supply disruptions boosts the fair value of oil prices by about $8 because of lower inventories. Now, in practice, I think prices would probably rise more in the short term as the market puts a greater weight on further escalation scenarios. Of course, the key question is how quickly can production come back? And when we go back to what happened in 2019 in Aberquake, production came back remarkably quickly. Prices jumped, and a few days later, they had normalized.
It is notable to me that the oil majors are not tracking oil prices the way that you might expect or the way that they have in the past. In fact, you've seen oil majors, the shares, trade at near record highs or at record highs. Jason Thomas of Carlyle just put out a note talking about how technology, new economy shares are down 5 to 10%, and old economy shares, including energy, are up 30 to 50% since October of last year. How far can these shares keep rallying, independent of oil prices that have kind of remained in this range?
Yeah, so I think there are two reasons why energy equities have done well. And to be clear, I cover the commodity, but I can summarize the research from my equity research colleagues. One, equity markets are more forward-looking than commodity markets. And while we are somewhat below the forwards for crude oil prices in 26, we are above the forwards from 2028, or long-term Brent forecast is 75, because we see this 2025 supply wave as a one-off, and we think oil demand grows to 2040. So I think equities are increasingly pricing this more robust long-term oil demand outlook and this slowing in supply. Second, I think the starting point for valuations of many of the old economy equities, including energy equities, was quite low. And I think this rotation from soft assets, including software stocks, sort of the new economy stocks, to sort of the hard assets, including energy, real estate, commodities, is a second driver of this outperformance of energy equities. And third, these companies have been well ran. Costs have been coming down. Technological progress is good, and so for a given oil price, they can generate higher higher margins than in the past when costs were higher.
Please forgive me. Citrini has made me a bit existential. I'm going to blame them for this next question. But let's just say that you do have AI gains that are as great as people expect. You do get this investment in the old economy. How far can that go if it comes at the expense of human capital, right? How far can it go if it comes at the expense of global economic growth, at least tied to the consumer?
Yeah, obviously highly uncertain how AI will exactly develop, GDP, labor income, capital income. But where economists have argued that in the past, productivity shocks, positive productivity shocks have been a positive for GDP and ultimately employment, even if in the short term you see some job losses, because ultimately productivity gains mean more income, more spending, and potentially new occupations, new spending needs. So that's also our base case for how AI plays out. Our view that AI will boost productivity and GDP in the US and globally is one of the reasons why we have above consensus long-term GDP forecasts and why we expect oil demand to grow through 2040. So that's the base case, but we'll have to watch the data. This time may be different, and our economists are laser focused on tracking the impact of AI disruption on labor markets. And so far, the hit to monthly employment in sort of the AI exposed sector seems pretty modest at around 5 to 10K per month in the US economy for now.
Daan, good to see you. Thanks for jumping on. Following that forecast revision, Daan Struyven there of Goldman Sachs on crude. Some tremendous research coming out of Goldman at the moment. You're going to hear this phrase a lot. Halo, heavy assets, low obsolescence. Here's the quote for you. Markets are rewarding capacity, networks, infrastructure and engineering complexity assets that are costly to replicate and less exposed to technological obsolescence.
Utilities at a record high. I mean, this basically gives you the exact sense that we're talking about. Staples, healthcare, and utilities all are the big winners in this halo effect. At the same time, you see software down 30% since the end of October. So it gives you a sense of just how much dispersion there is under this very calm hood.
Some real regime change in this equity market at the moment. We'll see if it sticks. Equities at the moment taking a turn lower, just slightly negative by not even 0.1%, with an update on news elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Jane Street was sued for alleged insider trading by the administrator winding down the affairs of Terraform Labs. The complaint claims Jane Street used non-public information to front-run trading that led to the collapse of Terraform and allowed the firm to unwind hundreds of millions of dollars in potential exposure. A Jane Street spokesperson called the suit desperate. Apple is bringing some manufacturing stateside, the iPhone maker announcing it will start building Mac mini desktop computers in Houston, Texas. Apple said assembly will take place in the same site where it began producing servers used in data centers to power AI features. Apple currently builds MacBook Pros at a facility in Austin. And Floyd Mayweather Jr. and Manny Pacquiao are stepping back into the ring. The boxing legends are set to meet on September 19th at the Sphere in Las Vegas. Netflix will stream the event worldwide. This will mark the first time Mayweather and Pacquiao have faced each other since their historic fight of the century back in 2015, which Mayweather won via a unanimous decision. That's your Bloomberg Brief, John.
I hate it, but I watch it, and maybe that means I'm part of the problem.
Wait, you hate it and you watch it? You can watch this?
I hate the idea of what boxing has become.
Yeah.
But at the same time, because it's Manny and Floyd, I'll watch it.
I'm looking up tickets.
And that means I'm part of the problem, right? Which is why they keep doing ridiculous things like this.
Or the solution. It depends on your perspective.
No, just boxing is getting too close to wrestling.
And to MMA?
No, to wrestling.
Too performative.
Too performative. Too theatrical, too staged. It's an exhibition. I find that problematic.
Yeah, you want the raw, old school boxing
when the best
matches.
would fight the best, and that changed a long time ago,
Can't we all
unfortunately.
just get along? I just don't like the punching.
Oh, right, you don't like the sport?
Yeah, I just don't like the idea that people get knocked out. That's my
Then definitely
thing.
don't tune into this one.
I won't.
I imagine you won't be watching. Up next on the programme, private credit jitters.
I'm not overly concerned with some of the areas in terms of redemptions, right? One fund doesn't really represent the aggregate market structure in terms of the vehicle that's of investment in a $2 trillion market.
Up next, we'll catch up with Craig Siegenthaler of Bank of America, live from New York City. You're watching Bloomberg TV. Equities just about negative on the S&P. We're down by a tenth, just about positive on the Nasdaq, supported by a big rally of AMD in the pre-market. The Nasdaq 100 is positive by a tenth of 1%. Just remember, at AMD, it makes up about 2% as a weighting of the Nasdaq 100. So some support there coming from that single name so far this morning. Elsewhere, a big focus on what's happening in private credit. Under surveillance this morning, private credit jitters.
I'm not overly concerned with some of the areas in terms of redemptions, right? The market structure matters a lot, right? And so in the loan market, if you're talking about private credit, the vast majority are in closed-end private funds where there are lockups. And so you won't have that redemption risk. One fund doesn't really represent the aggregate market structure in terms of the vehicle that's of investment in a $2 trillion market.
So here's the latest this morning. Blue Owl shares extending losses as investor anxiety rattles the private credit industry. So Craig Siegenthaler of Bank of America with this to say: there is a significant level of misinformation weighing on Owl and the private credit industry, which has led to a particularly attractive buying opportunity. Craig joins us now for more. Craig, welcome to the programme. That word misinformation, I'll give you some time just to get into that. Where do you think the misinformation is coming from? What's it about?
So, Jonathan, thanks for having me on the show. I mean, I actually have a long list that I kind of published in my report yesterday. But number one is transparency. Almost all private credit funds are forced to disclose their holdings quarterly. You can see if the loan's on non-accrual. You can see the spread. You can get color into the watch list. You can see data like pay in kind. So when I hear people say that private credit isn't transparent, it's really not true. That's kind of the starting point. I also want to remind you a few moments in time. There was a lot of news around Pluralsight 2 years ago, which was a default that Blue Owl and others had. And then also we had Tricolor and First Brands. Since that moment, the underlying portfolios have performed very well. And also the average Blue Owl private credit fund returned between +8 and +10% last year. So these aren't exactly bad returns. They're actually very good returns. And that's part of where the misinformation starts. But I actually published a list on page 3 of the note that I published yesterday. And it's kind of too much to put in a response right now on TV.
Of course, I understand. And they should reach out to you directly if they want the full list. And I've got the document as well to read through. The question I think you'll be asked, though, so here's an example question. If there isn't a problem with asset quality, when they sell a portfolio of loans, why do they need to sell to their own insurance company? What's the response to that?
So they sold $1.4 billion of assets. And this was across really 3 funds, but really 2 funds. One of the funds is a very small fund. It's called OBDC2. This fund is in runoff. They're allowing investors to redeem 5% a quarter. Instead of giving them 5, they gave them 35%. So, you know, when people said, hey, they're halting redemptions, it wasn't really true because they were expecting to get 5 and they got 35% instead. And those assets were sold at par. Now, they sold those assets to 4 investors. I do think one of those investors was the insurance business Blue Owl, which they don't own, but they do manage. But the 3 other investors were third parties. The 3 other investors set the price. So I agree. I don't like self-dealing when a private equity firm sells 100% of assets to themselves, and that happens sometimes. In this case, it was probably like 25% of the assets went to an insurance company that's managed by Blue Owl, but 75% or so of those assets were bought by completely third-party institutionals that set the price. That's why I don't think that is a big deal in my view.
Do you think, though, Craig, this highlights the concern about expanding private credit so significantly to retail investors or to semi-liquid funds at a time where there is a fundamental mismatch in maturities?
Okay, so private credit has done about 12% a year for 3 years. It's a very young asset class, and it's been growing. So most retail investors and most financial advisors are actually very happy with the performance. And I actually think private credit will continue to grow over the next decade in all 3 channels. Institutional, where there's very strong demand, insurance, where there's very strong demand, and retail. But retail will be a little more pro-cyclical. But what's very kind of interesting to me is why are retail redemptions picking up when performance has been very strong? And that's partly where I get to this sort of the misinformation, the fear that's coming from a lot of places, which isn't based on fact. Now, I will push back a little bit. A lot of the private credit funds, like the public BDCs, there's no asset liability mismatch. That is purely permanent capital. Now, inside the private BDCs, they are allowed to have a limited redemption. Now, in the future, if we have a recession and defaults are up, some of these private credit portfolios are going to have losses. Now, their losses will be way smaller than the QQQ or the S&P 500 index. So relatively, private credit will outperform. But when there's losses, that will spike higher redemptions. And then what the fund is allowed to do is limit redemptions down to 5%. That's how the product was designed. It was designed so that there would be no asset liability mismatch. So I do push back on that point.
Craig, we just have about a minute here. I'm just wondering, you seem frustrated. It seems hard to dispel some of these fears that continue to mount, particularly in the software loan sector. I just wonder, at what point do you worry it becomes a self-fulfilling prophecy where companies have to pay more for loans and then they actually do become more fundamentally stressed?
Yeah. So I've actually seen these moments before, which gives me confidence now. You go back in time, Blackstone B-Rate 4Q22. You had Apollo in the middle of 2020 dealing with its own issue. You had Ares in 4Q18. If you bought those three stocks at that moment, which I think is a similar moment for Blue Out, you would have got between 80 and 180% return in your shares over the next 12 months. So I've kind of seen these moments before, which is kind of why I'm not worried. But listen, I think a lot of people don't understand private credit, and that's why there'll continue to be misinformation. If there's a non-accrual that pops up next quarter at Blue Out, I assume there'll be a lot of negative articles on it, even if it doesn't matter that much.
Craig, thoughtful stuff, a constructive view, some pushback there. Craig Siegenthaler there of Bank of America. That stock cut in half over the last 12 months.
What's it going to take to disprove this, to dispel this? We have Salesforce earnings coming up tomorrow. We have CoreWeave on Thursday. Let's say they're blowout earnings. Is that going to be enough? Well, that's not what we've seen in the past. So you can feel the frustration. It's not terrible out there, and yet no one seems to be listening.
It's difficult out there, let's put it that way, and confusing. NASDAQ futures bouncing back by just 0.2%. Up next, Mahajan of Edward Jones, Beth Kindig of the IO Fund, David Seif of Nomura, and Matt Stucky of Northwestern. The third hour of Bloomberg Surveillance, up next.
We are in Liberation Day 2.0.
Markets would have been relieved to get past the tariff issue, and it seems like it's going to be front and center again.
Right now, it's a bit of wait and watch.
A high tariff scenario is where we're going to be.
I don't think it changes the overall narrative for the marketplace.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is going to be a long week. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this, just about unchanged on the S&P 500. On the NASDAQ, just about positive, up by 1/3%. For the week ahead, that long week, it looks like this and starts later on this morning. Consumer confidence, one to watch at 10 a.m. Eastern time. Going into this evening, the State of the Union. The President believes the State of the Union is A-OK. Consumers right now have a different view of things.
And frankly, for all of the efforts to try to change people's minds, it has not been working based on polls. What is the issue going to be that he's going to raise about how they're going to fix this, how they're going to cater to affordability, and how is he going to pair that kind of awkwardly with raising tariff rates in the wake of IEEPA? I mean, this is going to be a really interesting conversation that he has at the podium for potentially much more than an hour.
Especially given this latest Washington Post Ipsos poll, 64% of Americans don't like tariffs. So when the president's going to double down on it tonight, that might not bode well for his broader message on affordability. Also, what is going to be a problem? Higher electricity prices, higher beef prices, when he's trying to say that he inherited a mess and he's trying to turn it around, because all of this is about the midterm elections. On top of that, only 39% of Americans right now approve of what the president is doing. And you have these issues that he was winning on at first when he came into office that now he's underwater on. Affordability, one of them, but also as well immigration.
He's making a big push also for lower interest rates. The Chicago Fed president weighing in just moments ago, Austin Goolsbee. Not obvious that Fed policy is restrictive. More rate cuts require progress on inflation. The latest from him.
What's interesting, Austin Goolsbee of the Chicago Fed has been talking in this kind of tone, and we'll be hearing more from him with our own Michael McKee later this morning. But what was interesting is that Chris Waller, who has otherwise been fairly dovish, yesterday came out with a bit more of a hawkish tone, saying he really is on the fence. He could go either way with respect to a rate cut depending on the economic data. Is it going to be inflation, and this is really putting PPI on Friday in focus, or is it going to be potentially on the employment picture, given the fact that there is this existential fear about AI and what that's going to do to the labor market? Ultimately, it seems like these things are in conflict, but right now inflation very much taking the lead in a number of these conversations.
We also had Stephen Myron, what was it, last week, talking about the fact that if there's a better labor market, maybe he would readjust how many rate cuts he sees for this year. So the bar has just gotten so much higher when you have these latest comments from Governor Walsh, Governor Myron. How much harder is that going to be for the new dove, Kevin Walsh?
Super dovish, still dovish, but just turning a little bit more neutral over the last week or so based on the conversations and the communication we've seen so far. Check out this move in the pre-market. AMD up by more than 9%, supported by a move from Meta to buy all the chips that they produce, the computing equipment, and some stock as well.
Okay. This is Captain Obvious. We knew that this money was going to go somewhere, right? I mean, essentially, if they're going to be spending a combined $650 billion with their other three big tech leaders in the CapEx game, where are they going to be spending it? NVIDIA, they're going to be spending on AMD, they're going to be spending on these other companies. Why haven't those shares been rallying more? And that's been a big question. And, well, bam, here it is.
Big question for NVIDIA. Into the print tomorrow after the closing bell. Why is the rally of that name stalled over the past, 4 months?
And is it going to be because of some questions around China? Is it going to be around just how quickly they can get those chips, the question around memory? Or is this going to be just simply an oversight by people who have gotten carried away by their fears and suspicions?
The headline corporate act a little bit later. Talking for yourself, right?
Of course.
Carried away by fears and suspicions. NVIDIA tomorrow evening. Look out for that after the close. Coming up through this hour, Mona Mahajan of Edward Jones with stocks eyeing a recovery. Beth Kindig of IO Fund previewing NVIDIA's earnings. And David Seif of Nomura as Fed Governor Christopher Waller calls a March rate cut a coin flip. We begin this hour with stocks rebounding as investors seek trade clarity from President Trump's State of the Union address. Mona Mahajan of Edward Jones writing, the overhang of tariff policy remains and markets are reflecting this with some defensive posturing. We recommend staying diversified and staying invested. Mona joins us now for more. Mona, welcome to the programme. How would you frame what's been happening in this market over the past few months? There were some people who came on the programme and said this is a cyclical rotation, don't worry about things. Now it feels like a bubble is bursting.
Yeah, you know, John, it's interesting. It's a tale of two markets almost. On an index level, you could take a look at the S&P and say, well, we're flattish year to date. We've been pretty much in line with all-time highs, 1% to 2% below the most recent all-time highs. But underneath the surface, we know that there has been an aggressive rotation. And that rotation has really hit parts of the market that are not only being cannibalized by AI, think about the software names, but that are potentially being disrupted by AI. And we've certainly seen that in sectors like parts of financial services, parts of real estate, and parts of even transport and logistics. Now, keep in mind, none of those business models or revenues have actually shifted. This is still all speculative, but nonetheless, parts of the market that are holding up better, cyclical, but more namely capital intensive and what we call old economy sectors are certainly holding up better. And we think that trade likely has some legs here.
So, Mona, this is important because the traditional way to think about an equity market, whenever we get a move like this, risk on, risk off, is it defense versus offense? What's going to do well? Value versus growth? This from Goldman, I think, sums up things pretty well. When they say markets are rewarding capacity, networks, infrastructure, and engineering complexity, assets that are costly to replicate and less exposed to technological obsolescence. That summarizes the last few months. Do you think looking out, that's going to be the story?
You know, I think until we get some more clarity on how AI plays out, there will be some defensive posturing in the market, and that includes kind of gravitating or flight to safety in what we call those more capital-intensive parts of the market. Now, we've also seen a bit of flight to safety in precious metals and even that return to treasury bonds as a safe haven asset class. But nonetheless, we do think perhaps the silver lining here is as we look underneath the surface at the fundamentals, the U.S. economy is still growing at over 2%, we think, in 2025. And by the way, we do think earnings growth, S&P broadly, corporate earnings are up about 14% potentially in 2026 as well. And so we think those two factors alone, stronger economy and better earnings growth, underpins the fundamentals. And keep in mind, when you think about prolonged bear markets, deeper prolonged bear markets, typically they occur when an economy is heading into a recession or the Fed is raising rates aggressively. And those are not two scenarios we see on the horizon.
When you say fundamentals, I'm not sure exactly what fundamentals to look at. When I look at earnings, they look okay. I hear software names that are going to get tanked by AI, and then you see their earnings, and they look pretty good. They're actually growing really well. At what point will those fundamentals start to matter?
Yeah, I think certainly there has been a disconnect between what we're seeing in earnings fundamentals for some of the AI and AI potentially disrupted parts of the market and how their underlying sales and growth are actually turning up in the quarterly reports. Now, that I think there has been a bit of sell first, ask questions later. But we will see as this AI economy plays out over the next 12, 24 months, whether or not a lot of these fears come to fruition. And in our view, what we're seeing in the marketplace is probably a massive front running of what actually may happen and what actually may play out, not in 1 to 2 years, but perhaps 3 to 5 years. And so perhaps there will be opportunities in some of those beaten up sectors along the way. But for now, our recommendation is stay in areas, we like large cap and mid cap stocks, but within the sector preferences, we continue to like areas like industrials here. We continue from a regional basis to like areas like EM and parts of international, which are offering that earnings upside and maybe some diversification away from U.S. large cap software names. And we do like areas, within investment grade markets as well.
Have you gotten more pessimistic just in general about overall U.S. equity returns this year as we do see this churn and this lack of big tech reclaiming some leadership?
Yeah, I think generally S&P returns are driven by two factors, and those are earnings growth and valuation expansion. And the earnings growth we talked about, we think fundamentally remains sound, intact. The valuation part of the story, we think, has come to the forefront. And certainly we've seen higher value parts of the market, really the winners of last year as well, if you think about tech and financials, underperforming. But do we see scope for valuation expansion in parts of the market that might have some room for catch-up? Think about some of those cyclical industrial parts of the market. We think in an environment where the Fed maybe still has 1 to 2 rate cuts ahead of it, we have seen interest rates gradually move lower, that potential scope for valuation catch-up in parts of the market that haven't really seen much leadership, we do see some hope there. And so we think both parts, earnings growth, certainly in a broader market sense, but valuation expansion we think comes just from those maybe catch-up potential players.
But I know you spent some time on the Supreme Court decision and what the tariff policy now means for corporate America. If there are refunds, what do you think corporate America, Lisa's brought up this point a lot, does with that money?
Yeah, it's a good question. And, look, so far the scope for refunds has been pretty limited. We heard the president talk on Friday about it may take years in the courts. There has been no mechanism put in place. We don't see yet how the refund process could play out. But if we do see refunds, we do think, one, it does put money back in the hands of corporations who have been spending on areas like CapEx. We know from a tax perspective, CapEx certainly is more attractive in 2026 and going forward. And we also think, when we think about areas like, a lot of companies have had to absorb higher prices from inflated tariffs, and perhaps their margins have taken a hit. And so perhaps they do things like share buybacks or buying back their own stock if they think it's attractive. And so there is potential for a bit of both, financial engineering as well as CapEx spending, we think, coming from the corporations. But more broadly, we'd say interesting to note that despite the elevated tariffs really since Liberation Day last year, tariffs have not had that outsized impact on inflationary pressures that were at least the worst of many fears. And we've continued to see an economy that holds up.
True. Mona, good to see you. Thank you. Mona Mahajan there of Edward Jones. You alluded to EM. EM equities up double digits so far year to date. Checked in on the Kospi again. South Korean equities up 42% year to date.
You mean Samsung's up 42%?
Two names on the
Let's be honest. But at the same time, outside of the U.S., how much are people saying, well, it's a great time to go outside the U.S. because growth is expanding there. And guess what? We can be insulated from all of these stories versus fundamentals and all these questions around exactly whether AI. And I think that that's also pushing people to the certainty of Samsung.
There was this stable fat multiple on US equities, and now there's a question mark above it. And we've had an earnings-driven rally through last year, and now the question mark for the year ahead is whether we have a multiple-driven correction for the year ahead. Now, while we're having that debate and working out what wins and loses in this country, there's some certainty as to what wins elsewhere, and that's where I think the confidence is coming from.
What's fascinating is, in some ways, this is an endorsement of the Chinese model over the U.S. model, where they're going more into asset-light models and going into the software tied to AI and not necessarily the hardware of building out the data centers and just the scope of this, which really highlights some of the battles that we're seeing in some of Anthropic's recent missives about what's being stolen from them in terms of their IP from Chinese software engineers. But these are some of the discussions going on under the hood.
We'll talk about the data centers with Ed Ludlow in just a moment, so stay tuned for that. Equities on the S&P just about unchanged. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Shares of Novo Nordisk falling 2.6% in the pre-market. The company reportedly planning to slash the U.S. list prices for its popular weight loss and diabetes drugs by up to 50%. The Wall Street Journal reporting both Wegovy and Ozempic will sell for $675 a month beginning in 2027. Paramount Skydance has raised its offer to buy Warner Brothers Discovery. Sources telling us here at Bloomberg the new unspecified bid improves on Paramount's $30 a share proposal made back in December and addresses some concerns around financing. If the Warner Brothers board decides the new offer is superior to its current agreement to sell assets to Netflix, the streaming giant will have 4 days to respond. And the Northeast digging out of a powerful winter storm that dumped 20 inches of snow on New York Central Park. And more snow may be on the way. The U.S. Weather Prediction Center saying the stretch from New York to Boston could see a few inches Thursday night into Friday. The center also saying a more robust storm could arrive by the middle of next week. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the programme, the Morning Calls. Plus, we'll catch up with Beth Kindig of IO Fund, previewing results from NVIDIA, and catch up with Ed Ludlow on that breaking news out of Meta and AMD. From New York City this morning, good morning.
All of these questions that we're seeing jostle markets around are effectively challenging that notion about asset-light businesses, about high ROIC. And this is the market saying that we do not think your earnings power today should be infinitely capitalized into the future at its current run rate.
So what does that mean for the multiple on some of these tech names? That's the question that Cameron Dawson of NewEdge Wealth is asking, and others as well. Equity futures on the S&P 500 just about unchanged, on the Nasdaq positive by 0.26. We'll talk about AMD in just a moment. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Blue Owl to hold with a street low price target of $10, noting a challenging environment for net flows. That name is down again this morning by 2%. Your second call from JPMorgan cutting its price target on Workday, highlighting a deceleration in bookings growth. And finally, Wells Fargo upgrading Qualcomm to equal weight, calling its data center opportunity underappreciated. That name is up in the pre-market by more than 2%. Let's stick with tech. Meta committing to spending billions of dollars on AMD data center gear over the next 5 years. Bloomberg's Ed Ludlow has a story. Ed, that is quite a move for that name, up 9%.
Yeah, it's very large-scale deployment, so it's 6 gigawatts in phases, and you know it kind of replicates the structure that AMD has already done with OpenAI, a similar sort of arrangement where they are kind of getting into the bigger leagues, closing the gap on NVIDIA in this market. Overall, you know, AMD does $10 billion of revenue each quarter, all told. NVIDIA's just data center segment is $50 billion, so they're still a ways off. But you know what is interesting about this is, in particular, is it's AMD's kind of latest generation accelerator-based system, the MI450, And what they're really talking up is that you basically say to Meta, okay, let's do this together for 5 years. Your engineers come and work with our engineers, and you can help us install the systems. And that kind of projects quite a lot of confidence for the market toward AMD in particular.
So Ed, Lisa asked the question earlier. We know what the CapEx intentions are for the year ahead and probably beyond. And yet these stocks have been held back somewhat, notably NVIDIA, over the past several months. Ed, what gives? Where's the news here?
Yeah, I mean, the capital expenditures get stated, and then an assessment was made on the health of that, the portion of capital expenditures and its impact on cash flow. For example, it's very likely that Amazon as a hyperscaler will at some point flip into negative free cash flow, which everyone is completely calm about. Meta is not a hyperscaler. It doesn't sell cloud computing services, but the scale of its infrastructure that it operates is the same, right? And it is said $600 billion there or thereabouts over the next few years. And Mark Zuckerberg has gone a little bit beyond that, saying that actually in the scheme of things, it's absolutely okay if they spend a couple $100 billion. Misspend it is how he put it, or incorrectly. The risk of not spending it is greater. And, you know, on any given day in reaction to earnings, as long as that company shows top line growth in its bread and butter business, the market is either okay or not okay with that.
Ed, it's good to see you, as always. Looking forward to the programme. Ed Ludlow, a little bit later on this morning with Bloomberg Technology. We heard the same thing from Alphabet. The bigger risk here is under-investing and not over-investing. They said that, 2 summers ago? And we've seen the numbers climb ever since.
Yeah, and ultimately it was received pretty well back then, and right now it's not being received in the same way. What has changed? And I think that is really the question, especially as people talk about how this is going to be a game changer for the entire economy.
The next stop, of course, for big tech. NVIDIA results coming out after the closing bell tomorrow. Beth Kindig of IO Fund, a tech-focused stock portfolio, writing NVIDIA delivered its strongest sequential growth since Q4 23 last quarter. Blackwell Ultra will likely continue this strong momentum. Beth joins us now for more. Beth, welcome back. Let's just start with NVIDIA and why this bull market, this rally, has stalled, even though these big tech names are putting up some major CapEx intentions.
Yeah, I guess I would counter and just say typically the market all along has misjudged NVIDIA and many other AI semiconductors and AI hardware players. There has never really been a moment in the last 3 years where the market got it, except for maybe that one big blowout report with NVIDIA. What they're missing now is that the way these GPU generations work is that they ship in volume production, which means the strong quarter we saw, last quarter, which was one of the highest in 2 years. It's saying a lot. This company easily, comfortably beats basically every quarter. So saying a lot that it's the biggest beat in 2 years is likely to continue to flow. That momentum is likely to continue because GPU generations it's shipping in volume. It's in production volume right now. So what the market is missing is by keeping this stock range bound, it's now a valuation story. We're no longer at the Blackwell Ultra shipping is how big of a deal is Vera Rubin. We're at this stock is dirt cheap because it continued to put up strong quarters. And now the market kept it range bound. So personally, the way I look at this is it's a valuation story going into tomorrow night.
Calling it dirt cheap after it rose to be $4 trillion and then nearly $5 trillion of valuation is definitely a bold call, Beth. I just wonder, to make it simple, how low is the bar right now for NVIDIA to just sort of step over tomorrow afternoon?
Yeah, I would just counter and say I did not say the market cap was cheap. I said the valuation is cheap, which means on a sales ratio and an earnings ratio, we're looking at April lows. So I do want to make sure I clarify that.
Understood. I'm just wondering, though, going forward, given the fact that they have increased their revenues to such a big degree, and frankly, there will be more coming with respect to Meta and with respect to Microsoft and Google and the others. I'm just wondering how low the bar is. I mean, I do think that essentially if they show what they've been spending, even if they do have a big CapEx plan that they announce, that it'll be well received.
I think going back to your point that this is the world's most valuable company, that there is not a low bar for NVIDIA. I think the bar is always very high. And what I'm saying is that because the way these GPU generations ship, we're in volume production on Blackwell Ultra, that bar will likely be cleared this quarter. Where, I look at this forward and backward, of course, I'm very close to this stock. What we want moving forward is a smooth handoff to Vera Rubin. We want to make sure that generation ships on time. That is where I'm focused at this point because Blackwell Ultra is pretty much priced in.
Beth, do you think there are some doubts around that then?
There are only doubts because there was a little bit of a rough handoff to Blackwell. We had about a 6-month delay on Blackwell, and that is actually showing up a lot in this range-bound price action we've seen over the last year. The market has gotten complacent over the fact that there were these shipping delays. And it's simply because NVIDIA continues to challenge what is possible with compute. So there can often be moments where, while doing that, the way that it's built, qualified, and shipped, there can sometimes be some delays. I don't know that. I think Verhoeven's on time, but it's still something that you have to watch because they're doing basically the impossible.
You're right to raise the question. Beth, it's good to see you. Thanks for jumping on. Beth Kindig there of IO Fund on NVIDIA, a name that she herself, as she says, is close to. Looking forward to that report tomorrow after the close.
Yeah, and you pointed out that it's been range-bounded. It's been far below where it's got reached in terms of a record high. Even amid all of this CapEx spending, is it because of the Blackwell handoff? Is it because of some of the questions around China? Is it because of memory snags in terms of just supply chain constraints? Look, I'm curious how low the bar is, or are there some real fundamental concerns about valuations based on some of these kinks in the armor that people have been pointing to?
Also, what's going on with OpenAI and NVIDIA? We talked about this yesterday. They're pledging $30 billion. What happened to the $100 billion they were pledging to go into OpenAI? That invitation Jensen Huang has spoken about. I imagine that's going to be a big question tomorrow on the earnings call as well.
Looking forward to that call, without a doubt, and looking forward to the coverage from Ed Ludlow, who joined us a little bit earlier on AMD. AMD in the pre-market, just an update there, up still by close to 10% in early trading. NVIDIA's down by about 0.6%. The opening bell's just around the corner. In a moment, we'll catch up with David Seif of Nomura. He's calling for 2 more interest rate cuts this year. Plenty of Fed speak over the past few days. You'll get more a little bit later. And they're weighing in on AI and what it means for the labour market. And that is the debate of the moment, as GDP growth has been pretty decent over the last 12 months. But payrolls growth has been really, really muted. Plus, we'll get you some morning movers. Danny's going to drop by and break down a couple of things. Intuit up by 7.36%, a partnership with Anthropic. We'll discuss that in just a moment. From New York City, you're watching Bloomberg TV. Equities are positive by 0.1% on the S&P 500. Likewise on the Nasdaq, up by 0.4. The cash open 60 minutes away. AMD, the big mover this morning. Let's get your morning movers. Danny has more. Hey, Danny.
Hey, John. And it's all thanks to Meta sealing a deal with them to power a 6-gigawatt data center. And it will be all using AMD computers, processors. They're also going to get warrants to buy AMD shares. Lisa Su says that this is a deal worth in the multi-billions. We don't have the exact price tag, but it is enough to send shares higher by 10%. I also want to linger on Intuit shares for just a moment, announcing not that long ago that they are reaching a deal with Anthropic to power AI agents to their offerings to companies and different users, 7%. The reason I think this is interesting is that Trini's research report yesterday talked about this world in which the very companies who are being disrupted are the ones who are paying and spending on AI, spending on their own destruction. Anyway, that's not what's being priced in. It's a 7% rally in the pre-market this morning. Finally, ending with another sore spot for this market, and it is Blue Owl falling yet again, 2.5%. This time, the catalyst Deutsche Bank downgrading Blue Owl to a street low price target. It is a back and forth. Yesterday, Bank of America said that it was misinformation. The selling was overdone. So the two analysts clearly disagreeing on that. But the drama continues, John.
The stock cut in half in the last 12 months. Danny, thank you. The name down by another 2%. More from Danny and Matt Miller in about 30 minutes to guide you into the opening bell. Let's turn to the economy. Fed Governor Christopher Waller saying the chance for March rate cut is a coin flip.
If the labor market data for February are consistent with the stronger job creation, it may be appropriate to hold the FOMC's policy rate at current levels. If the good labor market news of January is revised away or evaporates in February, it would support my position at the FOMC's last meeting that such a cut should be made at the March meeting. I rate these two possible outcomes as close to a coin flip.
That is a change for Governor Waller. Bloomberg's Micah McKee joins us now from the National Association of Business Economics Policy Conference in Washington, D.C. Mike, welcome to the program. It feels like the tone is shifting somewhat. What are you hearing?
The tone is definitely shifting. It's similar to what we heard at Powell's news conference after the last meeting, that maybe inflation is becoming a bigger issue. And as far as Chris Waller is concerned, you take a look at what we got from ADP this morning. Their weekly number, 12,750, is the fourth week in a row that they've reported higher levels of hiring. So it may be that we get a fairly strong report a week from Friday, and that may keep Chris Waller on the sidelines. This morning, Austin Goolsbee, the Chicago Fed president, is speaking, and he's basically taking the opposite position from Chris Waller, that it is important to make sure that the jobs market stays healthy, but that inflation is the bigger problem. And he says unless he sees inflation going down, he's not going to be voting for more rate cuts for the time being. In his speech, he says, "I feel that front-loading too many rate cuts is not prudent. In every economic survey we have seen and in the many meetings we've had with businesses and consumers across the 7th District, people express that prices are one of their most pressing concerns. Let's pay attention." Now, if inflation does start to go down, Goolsbee says that he is willing to consider the idea of further rate cuts. In fact, he thinks they could have as many as 2 by the end of the year, but he's got to see that progress. We'll have plenty of other Fed speak today that you can try to glean clues from, but maybe the number of the week is going to be PPI on Friday. We've got the weaker than expected CPI numbers for January. This is PPI for January, and they can put together the PCE number, which is the one the Fed follows after we get PPI, so we'll have a better idea of whether those inflation numbers are coming down.
Mike, looking forward to the Fed speak later, of course, with you and the Chicago Fed president at 9:30 Eastern time, I believe, so about an hour from now. Mike, I want your view on the elephant in the room. What's holding back hiring at the moment, and what is the influence of AI? What are they saying about that at the conference at the moment?
Well, most people here say they don't really know for sure, but the feeling is it's not AI at the moment. It's the uncertainty caused by the administration's fiscal policies, trade policies. Companies don't know what is going to happen in the future. You layer on some AI uncertainty to that, and you have a reason for companies to be cautious in hiring. Austin Goolsbee met with some of us last night, and he talked about that and said that for him, it's more important to look at the rates, the unemployment rate, the hiring rate, than the absolute level of jobs, because at this point, we're having problems with the labor supply. It's gone way down. And because we don't know what's going to happen with trade policy going forward.
Mike McKee, thank you, sir. You take a break. We'll see you in 60 minutes again. Mike McKee, 9:30 Eastern time, catching up with the Chicago Fed President, Austin Goolsbee. Sticking with the Fed, David Seif of Nomura writing, "We continue to expect 2 Fed rate cuts this year, both occurring under Wash." David joins us now for more. David, good morning.
Good morning.
Let's get to that Waller speech. So here's a direct quote. "I can't dismiss the possibility that the labour market data has pivoted to a more solid footing." We've heard this a few times now. Central to all of this is whether that jobs report more recently was a one-off or not. Where do you stand on that?
Well, we certainly don't think that we're going to get in the 170K per month on an ongoing basis. But we do think that the labor market has been somewhat stronger than people had thought it was going into that report. And I think this is a clear signal that it is not as bad as people thought. So we see high 5-digit to low 6-digit prints on a regular basis later this year. That certainly looks poor compared to about 2 or 3 years ago, but it's a lot better than we got for most of 2025.
I think the central idea to all of this is that you can have a deceleration in jobs growth without an increase of slack in the labour market. And anchoring that view is the unemployment rate. Is that a good measure of the labour market? Mike gave a nod to it. What's your view on it?
Oh, yeah, we think it's a very important thing. And more importantly, irrespective of what we think the Fed thinks that it's an important measure. So it is clearly key to look at. I think especially right now, for all the problems that the unemployment rate calculation has, it is very good at dealing with the fact that demographics are changing, perhaps more sharply than people even realize right now. And so how do you evaluate a number on NFP today when the population is growing pretty slowly, if at all, versus just a few years ago when it was growing much more quickly? Well, the unemployment rate cuts through all of that. And so I think that's a key reason the Fed, especially now, is really looking at it.
Do you see inflation as taking on a greater emphasis right now, just simply because there is a sort of stasis in the labor market, and there does seem to be questions around just how strong, and certainly that it hasn't necessarily been as weak as many people expect?
I think generally speaking, the trend is really still focused on the labor market more than on inflation. Certainly a pickup in inflation would be something that the Fed would have to take notice of. We can all point out, we certainly have at Nomura, that this is going to be the 6th straight year, it looks like, where the Fed has missed to the upside on inflation. But it seems that by and large, Fed officials have in their own way, made peace with that. They've continued to push through a bunch of cuts, even though inflation was above target. And although you do definitely see, A, a lot of Fed speakers who are pushing back on that, and B, a hawkish shift in things, I think most of what is driving changes in the narratives right now is what's happening in the labor market. And it's despite the fact that we see inflation continuing to be above target that we think that incoming Chair Warsh will be able to push through 2 cuts pretty quickly.
You know, John alluded to the questions around AI and what this would do to the labor market. And what we heard from Chris Waller yesterday, the thing with AI is it's coming at us so fast that it's easy to start seeing jobs that may go away before you see the new jobs that are going to be created. He went on to say, I either think that you'll see some return to job growth coming in the next year, or we're in a period of economic activity I've never seen before in my life. There is a question about whether we are in a sea change regime. What's the Fed response if we do see some sort of job cannibalization from artificial intelligence?
I think if we were to see, and it's a big if, I want to be clear, but if we were to see massive job losses without close to an equal number of job gains, not our central case, but if that were to happen, then I think that then a dovish response is really required here.
I don't think that's the base case.
I think that historically, you know, we've had 250, 275 years since the Industrial Revolution started. We have had breakthrough technologies throughout history. Maybe AI is going to trump them all, but time and again, we've said, oh, you know, what's going to happen to all the coal miners now that we have the steam engine? What's going to happen to all the people who take care of the horses now that we have cars? And time and again, yes, there have been segments of the population that have lost very badly with new changes, but by and large, we have, without exception, seen the economy end up not just with higher growth, but with more jobs being created that would never have been imagined without prior to that technology coming to bear. So I think that, you know, as much as it's very easy to see jobs that could be lost under AI, it's much harder and requires more imagination to figure out what jobs would be created. Doesn't mean it's not going to happen. It really has historically.
When it comes to this year and the 2 cuts that you say happened under Kevin Warsh,
yeah,
when do we see Kevin Warsh actually take the helm of the Federal Reserve?
I think Kevin Warsh will be there for what is scheduled to be his first meeting in June. Yes, there's a lot of wood to chop, so to speak, but the president has shown that he can get nominations through pretty quickly when he needs to. We got the Myron nomination through in about 6 weeks. So I think he'll be there in time for that. And our thought is that at his very first meeting, he will push through the first of 2 rate cuts for the year.
And when it comes to the composition of the Fed, does it mean Jay Powell leaves and Steve Myron gets nominated to that chair?
I think Steve Myron will probably have to give up his seat for Kevin Warsh. He would certainly be at the top of my list for people who are likely to get open seats under Trump.
David, it's interesting you think he'll get what he wants at the June meeting. Given the picture of things that I'm getting from the Federal Reserve right now, that does not look like a committee that's ready to reduce interest rates. How much power do you think the Fed chair still has?
Well, I think this is going to be a really interesting dynamic. And I will say that when we look a little bit further down the road, I do think that there's going to be more limitations on Kevin Warsh's Fed chair than there have been probably on any Fed chair since Volcker. So 45 years where the Fed chair is no longer a de facto dictator. That said, I don't think it's going to happen in his very first meeting. And I think it's not like flipping a switch, right? There's a lot of institutional inertia where the Fed chair is able to push things through.
Come on, David, how does this actually work in practice? And you know better than I do.
Yeah.
Just because he turns up, we will sit around a table and go, he's the new guy. Let him get what he wants for a meeting.
We still have, despite a lot of the hawkish Fed speak over the past week since the job numbers came out, we still have an FOMC that, if you look at the dot plot, makes it look like of the 19 people on there, 17 or 18 are in favor of additional cuts. And I think that if Kevin Warsh comes in and says, OK, everybody, it's time to go ahead and cut now, a lot of them are either going to just say, OK, I was on board with that, or might not have been on board with this quite this early, but I'm not gonna sort of defy the new Fed chair right away. Now, if Chair Warsh is able to push through a couple of cuts and then he wants to go for more, it's a big if, but if he does want to, and inflation is still high and job growth is becoming more robust and the unemployment rate is falling, then we could start to get real votes on the FOMC, where it starts to look like, hey, wait a minute, we got to count the votes. It's not just the Fed chair gets whatever he wants.
Real votes, that's a novelty, hey?
It would be for the Fed.
Fun.
It sure would be.
That'll be fun. David Seif there of Nomura Securities International. Thank you, sir. It's good to see you.
My pleasure. Always
it's going to be an
here.
interesting 6 months. I don't think anyone really knows what we're going to get in any way, shape or form. We've got a baseline. There's another baseline for 2 cuts later this year, but around that, a lot of doubt.
Baseline is doing a lot of heavy lifting this morning. I think that Tom Tillis doesn't really know either because there's a lot of contingencies to even have the hearing in the first place.
And it was interesting because Bob Michael of JPMorgan had a little bit of consternation about how quickly this will be, and he put that emphasis on nominated Fed chair. So basically saying this could be very noisy. And to your point, there's no date on the calendar yet to start that hearing.
The calendar is empty. We'll see what we get. Equity futures turning higher by 0.1% on the S&P with an update on stories worldwide this morning with your Bloomberg Brief. Back with us. Here's Yahara. Hey, Yahara.
Hi, John. Meta announcing a blockbuster deal with AMD. Those shares up 10% in the pre-market. The Facebook owner will spend billions of dollars on AMD data center gear over the next 5 years. Meta will also receive warrants to buy 160 million AMD shares. Those shares will vest when the project and AMD stock reach certain milestones, turning Meta into a major shareholder. Last week, Meta announced a tie-up with AMD rival NVIDIA. Meanwhile, Warner Brothers Discovery confirming our story that it received a revised proposal from Paramount. The new bid improves on its $30 a share offer and addresses concerns, including certainty of financing. Warner Brothers says it's reviewing the offer, but its board continues to recommend a deal with Netflix. And President Donald Trump invited both the men's and women's gold medal hockey teams to attend the State of the Union tonight. The women's team declined, while many of the men's team are planning to attend. You can watch Bloomberg's coverage of the State of the Union starting at 8 p.m. Eastern. We'll have full coverage and analysis of the president's speech, plus the Democrats' response. That's your Bloomberg Brief. John.
Yahara, thank you. Based on the scenes we've seen, without a doubt, they're attending that hungover. Without a doubt.
Oh, my God. They were at 11 last night in Miami. Yeah.
All I can say, I think it's going to be a really interesting contrast to have the hockey team next to the Supreme Court justices.
Yeah, that vibe's
President
different.
Trump talking about both. I just think it's going to be really interesting.
That vibe's going to be different, without a doubt. A well-earned hangover, that's for sure. Up next on the programme, setting you up for the day ahead, plus Matt Stucky of Northwestern Mutual, looking for the next names to benefit from AI from New York City. You're watching Bloomberg Surveillance.
I'm not worried about credit here as long as recession isn't on the horizon. And right now, recession seems a long way off. The first loss pieces of structured credit, much like that 05 to 07 period, are starting to crack. Now, history doesn't perfectly repeat, but it rhymes. It's something to keep an eye on.
The bond market guys feel good at the moment. That was Bob Michael of JPMorgan Asset Management feeling good about Treasury yields close to the lows of the year, just about unchanged. The 10-year at the moment, just north of 4%. The equity guys dazed and confused beneath the surface, particularly beneath the index level. The S&P 500 at the moment, wild sector moves, single name moves. At the index level, 2% away from all-time highs on the S&P 500. Amazing. The Nasdaq up by another 0.5% this morning. The opening bell about 41 minutes away. Going into that opening bell, here's the trading diary. The week ahead today, tons and tons of Fed speak from Goolsbee, Waller, Collins, Bostic and Cook. Then we get some consumer confidence data at 10 a.m. Look out for that ahead of this. It could set the tone for it. The President delivering a State of the Union address at 9 p.m. Eastern Time. Then tomorrow we hit the ground running. NVIDIA earnings after the closing bell. Thursday, another round of jobless claims. Friday, PPI data. Let's turn back to equity. Stocks recovering slightly following another sell-off driven by AI disruption fears. Matt Stucky of Northwestern Mutual writing, we like owning the constraints to the AI build-out and contemplating the next phase of beneficiaries. Matt joins us now for more. Matt, welcome to the programme. Let's contemplate that now. What is the next phase of beneficiaries?
Well, I think in terms of the next phase of this, it's turning all the investment into returns as it relates to corporate America. We've had a lot of pilots that have been rolled out in terms of companies testing this technology. Now it's time to probably start to see that impact the P&L, either through expense reduction or through revenue generation. And so that's kind of, I think, how to think about 2026, and companies that can help facilitate that, to me, I think are in a prime position to see maybe some business accelerate as we look forward to this year.
Matt, is this going to be a single name story or a sector story? Should we expect lots of bifurcation or a tide that lifts all boats?
I think it's bifurcation, but at the same time, I think it's going to be a more volatile bifurcation. And let me kind of explain what that means. Certainly, there's going to be a lot of headlines, and we've seen that in spades so far this year. And just today, we're going to get another update from Anthropic in terms of enterprise agents, and I'm sure this is going to cause some additional single stock volatility that we've seen impact software, in addition to insurance and financial services names. And so diversification is paramount, I think, in these types of environments. However, underneath the surface, that broadening is continuing, and it's continuing in areas like consumer staples, which from that perspective would make you cautious in terms of why is consumer staples leading this market higher. But then you also look at the weighted S&P that's up 5.5%, similar to small cap, against a tape in the S&P 500 that's flat on the year. So there's mixed signals, and I think that just my take on that is simply just broadening away from some of the mega cap leadership that we've seen in the last few years.
It seems like, Matt, a lot of people want to avoid the volatility. They want to avoid software. They want to avoid, at this point, financials that might be subject to some sort of disruption. At what point do you go back in? At what point do you say, OK, there actually may be some dislocations here that I could take advantage of, rather than just hiding out in consumer staples?
That's a really good question. I think it's really difficult to disprove something that isn't really happening yet, right? So you have a narrative attached to these stocks, whether it's financial services names like S&P Global, where there's concerns about some of their data business, or whether it's software names where historically these businesses were systems of record. Now you have competing systems of intelligence, and who's going to win that battle back and forth. The reality is probably just going to take time. And how do you trade through those environments? I think to the point I made earlier, diversification is your best friend in those environments, along with a longer term time horizon. Just the structure of the market today, with so much more participation with the retail trader, and so much more participation in terms of pod shops, trading these names back and forth, volatility is probably to be expected to be elevated for a while. So to me, in terms of how you navigate that, I think there's a few things that you got to keep front and center in terms of what you're looking at. One is, what's the long-term business fundamentals, and how does artificial intelligence potentially change that? What's the valuation context that you're entering in? And marrying that with a reasonable time horizon is probably the best way to navigate this environment.
Is it also to just avoid the United States for now and just go elsewhere, especially given the fact that a lot of people see it as undervalued?
I don't think I would go that far. Certainly we preach diversification outside the United States as well. But if you're looking at some positive earnings revisions trends, it can be found in the United States as well. It's not just U.S. large caps anymore, or tech anymore. It is small caps. It is mid caps. And in fact, if you go back to May of 2025, one of the areas of the strongest earnings revisions up and to the right is small cap stocks. And so I think that's an important part of a portfolio. And I think if you're looking at just overall kind of portfolio construction today, the U.S. has to be a major component of that.
When you see deals like this morning with Intuit and Anthropic, is it time maybe to look at some of these software companies and think they're the ones that could benefit from all these changes?
Well, I think if there's a bull case for artificial intelligence that somebody's going to win a lot longer term, I think you have to discount maybe a percentage probability that some of the incumbents are going to win a piece of that prize. And it seems like, at least so far this year, that prize has been at the expense of the incumbents, and gravitating towards more of the semiconductor names and the frontier LLMs, the likes of Anthropic. The question is whether or not these systems of record that own rich data sets that are owned by these enterprises across the Fortune 500 can integrate AI functionality through APIs from the foundational LLMs, whether or not that can can be a solution longer term to keep them front and center in terms of their ability to provide value to enterprises across the Fortune 500. I think I'm open-minded to that outcome. And the announcement this morning from Intuit might be a framework for how this goes forward. But it's just the question of sustainability, whether or not this is going to continue in terms of these types of announcements. And you certainly need those types of headlines if you're bullish on software from this point.
Hey, Matt, it's good to see you. Thanks for dropping by. Matt Stucky there of Northwestern Mutual Wealth Management. The final point there, partner or get eaten, seems to be the theme at the moment.
Yeah, the problem is that even if you do partner, you could also still get eaten. I mean, it's sort of this interesting. So the CEO of Anthropic, there was a podcast that I found really interesting a couple of weeks ago, and he said the reason why software is getting cannibalized first is because these professionals are the most adjacent to a lot of the AI, so they're most likely to adopt it first and then get cannibalized by it. So it becomes this very sort of self-fulfilling prophecy. At what point does the machine eat you?
Well, that's a good point. I don't think we're there yet, but that's why some of these software companies are in a prime position, though. They have all the work set up to just make their software so much better using AI. I think then the bigger question is, do they need less people? And I wonder if the next wave is going to be potentially some of the layoffs at these companies.
I think that's a central question for us all at the moment, for more reasons than one. Elsewhere, the equity market positive by 0.2% on the S&P. The opening bow just around the corner, 34 minutes away. Coming up tomorrow, Julian Emmanuel of Evercore, Kate Moore of Citi, the Port of LA Executive Director Gene Soroka, and the US Trade Representative Jameson Greer following the President's address to the nation later on this evening. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.